in just a moment. Live from New York City, this is Bloomberg.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We've made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, counting you down to payrolls. That report about 45 minutes away. Equities right now on the S&P 500 positive by 0.7%. Bonds not doing much. Yields unchanged, 388.17 on the week on a 2-year, Bramo. It's quite a move on a 2-year so far this week, down by around about 15 basis points coming into today's session.
Even with Jay Powell taking March all but off the table, basically the boom moment that Ellen Zentner talked about, where he actually said something definitive, that it was unlikely that March was going to be the time that they started with rate cuts.
The boom moment was yesterday afternoon when Meta earnings dropped. Under surveillance this morning, a magnificent year.
2023 was our year of efficiency, which focused on making Meta a stronger technology company and improving our business to give us the stability to deliver our ambitious long-term vision for AI and the metaverse. I think that being a leaner company is helping us execute better and faster, and we will continue to carry these values forward as a permanent part of how we operate.
Here's the latest this morning. Meta cutting 22% of its headcount in 2023, and it's paying off. The company posting a 25% gain in sales, announcing a $50 billion share buyback, and issuing its first ever quarterly dividend. A blockbuster earnings report, but Mandeep Singh of Bloomberg Intelligence warning top-line comparisons are likely to get tougher in the second half as the company likely saw tailwinds from a cyclical rebound in advertising spending and improved ad attribution and measurement. Mandeep Singh joins us now for more. Mandeep, let's go straight to it. How do you cut your staff that much and grow that much at the same time? How impressed are you?
I mean, that's where, a founder-led team can always out-execute you. And Mark Zuckerberg has shown time and again that they are the most nimble product team when it comes to shipping new product, making those improvements in ad infrastructure. And look, we're talking about how user growth and engagement was decelerating. They are applying AI to actually accelerate user growth. The scale at which Meta is at, 4 billion users across its family of apps, the fact that they are able to accelerate user growth is telling you that, they definitely got that AI part right. And that's what's helping them with both user and engagement growth now.
Yeah, it's basically half of the globe is hooked into the Meta ecosystem in one way or another. I am wondering, Mandeep, given the fact that they own the world, seems like, in their eyeballs, how much can you really sort of doubt their ability to climb past this if they're able to do this without the staff, they're able to do this without the overhead, and they are deploying tools that you see as highly effective?
Yeah, look, I mean, 1 year back, we were talking about how this company was struggling, given the ad environment. And there is a cyclical component to it, no doubt about it. But what Meta did right was those investments they made in building their own foundational large language model. And look, this is a 50% EBITDA margin business. We know digital ads are the best businesses. The question remained about the relevance of apps and how much engagement they could sustain given the competition. But they've shown they have applied AI the right way, and you don't need, as many people. They could do it with 25% less people, and they're shipping new products and making those improvements that are needed to sustain that engagement.
Does it surprise you, Mandeep, that yes, they beat earnings, yes, they introduced a dividend, but the shares are up 17% after the gains that we saw last year? I mean, are these moves sort of shocking to you, just in terms of how much has not yet been priced in versus this morning?
I mean, look, they guided for 25% growth next quarter, so there will be upward revisions for 2024 and 2025. And, from a stock perspective, you have to ask yourself, is this a recurring revenue business or is it a cyclical business? And the answer is the latter. And with ad spending, I think we are in the part where ad spending is recovering, but we also know it's tied to, recession or macro, and it's very discretionary. I mean, one metric I would say is they say Chinese advertisers are 10% of revenue, and they contributed to 5% of growth. Now, we know if something happens or were to go wrong with that China aspect, and, Shine and Temu, they were to pull back from the US market, that would make a big dent on Meta's growth. So clearly there are those factors if something were to happen on the regulatory side. I mean, if they're restricted, which they are in the EU, but it doesn't show up yet in their numbers, that's a big risk factor. So the risk factors are there, but they clearly are executing very well.
Mandeep, I want to ask about that. We're seeing such high spending by China-backed advertisers. So for Meta, China was good, but for Apple, China was terrible.
Yeah, I mean, look, in the case of any e-commerce company that wants to develop a business in the US, there is no better customer acquisition channel than Meta's family of apps. Yes, you could go to, the smaller players like Snap and Pinterest, but Meta is the platform where you acquire new customers as an e-commerce platform. And they called that out yesterday. E-commerce advertisers across the board ramped up their spending on Meta. In the case of Apple, I would say, we knew the units would be down and they're probably losing some share to Huawei. But I wouldn't be surprised if, the refresh does come back, albeit at a slower pace, because they haven't launched a new phone with large language models. At least they mentioned it on their earnings call yesterday. So that's coming.
Mandeep, we've heard a lot now from big tech. In fact, they've all delivered. So let's talk about it. Who's doing best when it comes to AI integration? Who's executing well from your standpoint?
I mean, Microsoft is definitely out of the league when it comes to integrating AI on their cloud and applying it to all their software and its recurring revenue. I think that's the key, that they will be able to sustain that growth, and there is high visibility. I would give credit to Meta in terms of applying AI. They have their own foundational model. They have open sourced it, and actually it's helping them develop an ecosystem. So clearly, Meta has got that AI part right, and Alphabet is somewhere in the middle. I think they need to ship more products. They need to improve the cadence, which is what Meta has shown. But Meta would be the Alphabet would be the third one in my book in terms of the ranking.
How do you think Alphabet just changes the perception of things right now? It just feels like to me that for a lot of investors, they're looking at a company playing defense. They're not on the offense when it comes to AI. There's just big worries about the cloud business, or rather the search business, being decimated by something coming from another company. How do they change that?
Well, so clearly there is a risk because 90% share for search belongs to Alphabet. And they are pitching responsible AI because they don't want to be in a situation where, something goes wrong with the large language model deployments, and then they have to, pivot back completely to what they have. So they are taking a safe approach, where they want to apply large language models to queries where it's applicable, but not to everything they do, because it will be disruptive to their, search margins. And I think that's where it is the right thing to do, given their incumbent position. But I don't think they are behind. They seem to have caught up in terms of the large language model technology. It's just a question of how they deploy it.
Not to put you on the spot, Mandeep, but some people are talking about how it's not really the Magnificent Seven anymore. It's the Magnificent Four, the Magnificent One, the Magnificent Six. If you had to go out there and sort of bucket these, which are going to be the growers and which are going to be the laggards in the next year?
I mean, the sustainable ones seem to be Microsoft, Amazon, Alphabet. I would put Tesla and Meta as the ones that are vulnerable, which don't have that recurring revenue stream. To me, that's very important. That's why you see, the gyrations in market cap, as we have seen with these companies. It's hard to imagine how mega cap names can move like this, as was the case with Meta. But the reason is a lack of recurring revenue. And I think with AI, that doesn't change. And the first three are diversified businesses. Look, diversification helps when you get into a period of slow economic growth. So I do think Microsoft and Alphabet and Amazon clearly have that diversification aspect to it.
Hey, Mandeep, thank you. It's good to hear from you, sir. Mandeep Singh there of Bloomberg Intelligence. Before we run away and jump into payrolls, let's just sit on that stock move from Meta. 16, 17%. So $1 trillion market cap yesterday at the close. So we're talking about a move of about 170 billion, okay? So go to the S&P 500, slice it up on the Bloomberg, and go to companies valued between 170 and 180 billion US. IBM, Wells Fargo, Walt Disney, Verizon.
They're adding a Verizon this morning.
You're adding a Verizon this morning. You can't overlook this. This is huge. It's just absolutely massive.
Which is the reason why Michael Hartnett over at Bank of America is talking about how the stock frenzy into some of these names is reminding him of the dot-com era and some of the moves that he saw then. He was talking about the bubble of 1999, and we've heard this, right, for how many months? And yet we're still seeing this.
Except it's real money.
Exactly.
It's a $50 billion buyback thrown into the mix as well.
And you actually look at the cash flow, and it's incredible. And what we just heard there from Mandeep is it's a cyclical business, and they're benefiting on the way up, and then they're building in ways to benefit on the way down.
It's pretty amazing. The doubts that were around this business at the end of 22, start of 23, we're talking about the year of efficiency. It's more than that, more than efficient, what we've seen over the last 12 months.
Just sit on this stat for a second. They have 4 billion users across their platforms. 4 billion users.
Yeah.
What percentage of Earth is that? I mean, really, if you think about that.
Daily watch time across apps increased 25% from a year earlier. People are just scrolling more.
Just incredible execution, absolutely incredible. Coming up on the program, Nadia Lovell, UBS, former Fed Governor Randy Krosner, Mohammed Al-Erin of Queen's College, Cambridge, Jeff Rosenberg of BlackRock. It is Payrolls Friday, the Payrolls Report, next hour.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. So this is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
You were offered a money-losing women's basketball team, And you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They'd made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
This is Bloomberg.
We're looking for a strong payroll report.
I think the labor market is basically chugging along. It's tight. We're not adding a lot of new jobs.
The labor market, our view is it's slowing, it's weakening.
If the economy and the labor market do start to weaken in a meaningful way, it would accelerate the thinking at the Fed.
If we just see similar softening in the labor market over the next couple of months, then I think the Fed will be ready to cut come May.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It is Payrolls Friday. That payrolls report is 30 minutes away. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Alongside Lisa Abramowitz together with Anne-Marie Hordern, I'm Jonathan Farrell. Your equity market is positive. Your number this morning, 185. The median estimate in our survey. Lisa, going into payrolls.
And this is the interesting thing, is that you've got people with above that in terms of expectations who are more pessimistic and people who are below that who are more optimistic. I'm looking at Andrew Hollenhorst of Citigroup just publishing, saying that they have 240,000 penciled in, but that's the last one and it's all going to go south from here. So, you know, really it's going to be under the hood and about sort of interpretive commentary afterwards.
We heard so much of that last year, didn't we? How this was all going to decelerate and then the numbers just kept on coming. This is not where we thought we'd be. A year ago, looking out 12 months, 185, a median estimate. Anne-Marie, unemployment, 3.8%. Again, looking for unemployment to stay below 4%.
If it stays below 4% in this report, then that would be 2 months exactly of unemployment under 4%. You heard what Jay Powell had to say this week. He said it's the best employment market we've had in terms of this unemployment rate in 50 years. This is why in the last payrolls report, Janet Yellen, the Treasury Secretary, went on CNN and basically declared, look, we landed. It's a soft landing.
I heard what Chairman Powell said in August 2022. He talked about pain. We all agreed with him. We thought we'd have to see some pain to get inflation back down. Can't see that pain in these estimates right now this morning.
The pain maybe happened in very small places, and then it quickly was erased, and maybe those are the places that are rebounding. And this is the shift, and you've pointed this out really well, John, that basically we heard Chair Powell saying that we do not need to see weakness in order for them to cut rates, that this economy can see the disinflation while also seeing some sort of ongoing strength, and that's the shift. So even if we get a good report, it doesn't mean that they're not going to ease policy.
They don't have to push against it anymore. It's a much more market-friendly Federal Reserve, and I think the market picked up on that in the last few months. Speaking of pain, do you remember the cage match between Mark Zuckerberg and Elon Musk?
It didn't happen.
Didn't happen, right? Thomas Thornton just wrote in on the Bloomberg terminal from hedge fund telemetry, and he said this: the Meta gain is nearly 4 times the full price Elon paid for Twitter. let that sink in. I'd say the cage match was won by Mark.
Oof, especially
that's going to sting.
That's going to sting, especially because Threads actually came in with a little bit better in terms of who they're adding on. That was well done.
That was nice, wasn't it?
Good
Just
job.
wanted to share that. Meta up by 17% in the pre-market. Coming up this hour, Nadia Lovell of UBS on the market's tech earnings lift, former Fed Governor Randy Kroszner on what the January payrolls report means for the Fed, and reaction to jobs data with Mohammed Al-Erin of Queen's College, Cambridge. All of that and more over the next 60 minutes or so. We begin with our top story. Stocks rising on big tech's earnings lift. UBS Global Wealth Management CIO Mark Hafley writing this: we believe the investment case on tech, including AI, remains intact, and recommending investors use undue correction in quality AI leaders as a buying opportunity. Nadia Lovell joins us now for more. Senior US equity strategist at UBS Global Wealth. Nadia, great to catch up with you. Let's start with this one on tech. What isn't there to like about this sector right now?
Exactly. I mean, we can't agree with that point more. You know, there isn't much that you can pick at. I mean, the Mag 6 or Mag 5 or whatever you want to call them now, bars were high and they meet and exceeded those expectations. I mean, when you look at the AI monetization that's happening already at a faster pace, that's quite encouraging. So we see that those that have exposure to AI are faring better. But it's not just about AI. You're looking at the cloud infrastructure spending as well. I mean, you're seeing that optimization is now behind us. I mean, companies are seeing margin expansion despite the fact that you're seeing AI investment. And what that's telling us is that some of the cost initiatives and the cost control still remains tight, particularly around headcount rationalization. So some of those efficiency things that went into place are starting to bear fruit. And when we look across in terms of the CapEx outlook that we've gotten from some of the hyperscalers, John, wow, I mean, that is going to be a positive for some of those AI semi companies as well as hardware companies. So we still feel good about tech. We think that this is a sector that's going to deliver very strong earnings growth this year. Some of the best in the S&P. We know that the Mag 7 has been the one driving S&P earnings, and they're going to continue to do that this year. So we're definitely in the camp of taking advantage of any sort of pullback with a focus on those names that are more enterprise facing and have AI exposure.
Nadia, these aren't large caps, they're mega caps. That's what we call them now. You also like small caps too. Can you just go through why, when you've got all this growth taking place in the mega caps right now, earnings growth, revenue growth, the stock price performance, I'm going to ask the question a different way. What is there to like about small caps right now?
Well, when you look at small cap, you know, I mean, we saw a decent rally into year end, and some of that has faded at the start of the year, but we do think that there's an opportunity here for small cap to catch up. As you guys have been talking about for weeks now, the strength in the economy that's happening. We also know that there's a Fed that's in the position to cut this year, and that should be beneficial to small cap. And you're seeing a recovery in the manufacturing areas of the economy. Look at the ISM numbers yesterday, and also you're seeing a pickup in new orders. So when we think about a broadening out of the performance, I mean, small cap is sort of has been left behind. It's still about 20% below its all-time high that was set a couple of years ago. We think that there's an opportunity here for small cap to catch up. And so that's where we're taking our cyclical exposure. If the economy continues to surprise to the upside and the consumer holds in there and the Fed cuts later this year, this should be beneficial for those smaller companies.
All right, bear with me while I try to make this connection. But we were talking to Greg Battle earlier, and he was saying that he's concerned about Apple's China exposure. And he was looking for less China-exposed companies. How much are you seeing small caps as the way to do that? Leverage to the U.S. economy, not levered to some of the weaker spots like China?
Absolutely, Lisa, for that point. I mean, the strength in the global economy is coming from the U.S. and the U.S. consumer. So we think that that is a way to play that continued strength. I mean, and sort of buck the trends that you're seeing overseas, where there's weaker growth, whether it be in China or even in Europe. Let's just be honest about this. It's the U.S. that's carrying the global economy right now, and we think that that's going to continue to be the case, and small caps should be able to benefit from that.
If you extrapolate that out, how much are you actually checking some of the large cap and mega cap companies for that exposure and avoiding some of those? You're talking about maybe it's not the Magnificent Seven anymore. Is that something that you're kind of playing with or right now to kind of move away from those companies and shift more to those that are more isolated to the domestic economy?
Well, we're quite selective in large cap companies. You know, I mean, even among the Magnificent Seven, we're quite selective about around that. I mean, what we're looking for is companies that also have good self-help story. I mean, when I talk about self-help, I'm talking about, you know, companies that have restructuring opportunities, product and portfolio optimization, and cash use optimization, whether that be a return of cash to shareholders or through M&A. I mean, you saw some of this among the tech companies, and a lot of them has been benefiting from those, you know, efficiency gains over the last year. It's not just about AI, but we think that this, you know, you can see those opportunities in other areas of the market. When you look at even some of the banks that are looking to streamline their business and headcount rationalization, you're also seeing this play out even among some of the industrials and material names that are also launching new products and really having caution initiatives. And remember, some of these industrial and material names also have the benefit of the potential tailwind if this economy continues to, you know, grind ahead, and you're seeing that recovery in manufacturing. And you're seeing quite a bit of an investment on onshoring as well, and infrastructure investment that should be able to benefit those companies. So I don't think it's just about tech, even though we think tech will continue to perform. We think that there are opportunities in some other areas of the market and some sectors, but you have to sort of be, you know, single stock minded and very selective.
Nadia, let's get to the banks. 2 days, regional banks down by almost 9%. Can we talk about the monster under the bed called commercial real estate? Have we dealt with that issue now?
You know, I mean, yes, yeah, I don't think we've completely dealt with the issue, but of course, we do believe what's been happening this past week in terms of New York Community Bank seems to be idiosyncratic, but it is something that's worth watching because we do think that, you know, there could be some potential issues in the commercial real estate market, or as that wall of maturity comes over the next couple of years. But we think what's different versus what you saw last year in the regional banking crisis is that everyone is talking about it. And so that helps the market prepares better for any sort of potential risk versus last year. You know, I don't think very few people saw coming the impact of the potential for deposit flights out of the regional bank and the asset and liability mismatch in a higher interest rate environment. We've been talking about commercial real estate and potential issues in that space for the last 2 years. So I think that better prepares the market. And the large cap banks have, been building reserve for the last couple of years around this. So they're better able to absorb, but we have to continue to monitor any potential issues within the smaller banks.
The focus is on the smaller banks, that's for sure, and not on the larger ones. Nadia, it wouldn't be an interview with you and I without talking about what's happening with energy. You knew where I was going. You became a little less constructive on crude. I remember you changed your target last time we talked about it. What was it that changed your mind? What is stopping crude from rallying?
It's the U.S., in terms of the amount of supply that the U.S. continues to produce. The concerns around the potential for oversupply in the market, aren't, we think that there is over concern, but, some of it is somewhat valid. But when we do look at, sort of the inventory data, we're seeing crude oil inventory come down in January, weather disruption, as well as the OPEC plus cuts. And even yesterday, we heard from the JMC, high compliance from the OPEC cuts. So we do think that cuts will be extended in the second quarter. We're looking for modest upside at this point from oil. We do think that the oil market will remain slightly under supply in the first half of the year, and that should help support prices. But reality is things are going to remain volatile because the market needs a little bit more convincing, and we understand why. So that's why we lowered our targets, because the supply has surprised to the upside.
Got it. Nadia, thank you. As always, good to catch up on Payrolls Friday. Nadia Lovell there of UBS Global Wealth Management. On this Payrolls Friday, 185,000 is the estimate in our survey. Let's get you an update on stories elsewhere this morning. We can do that. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. NVIDIA CEO Jensen Huang says countries around the world aiming to build and run their own artificial intelligence infrastructure will only drive up demand for his company's products. Wang told Bloomberg TV nations are talking about the importance of investing in sovereign AI capabilities.
It is become abundantly clear to each one of the countries that their natural resource, which is the data of their country, should be refined and produce intelligence of their country for their country.
Tesla is recalling nearly every vehicle sold in the U.S. because some warning lights on the instrument panel are too small. Regulators say they may be hard to read, increasing the risk of a crash. The move applies to nearly 2.2 million vehicles. Tesla says it will be fixed with an over-the-air software update. The EV maker also seeing a slump in deliveries in China, down 24% from December, according to China's Passenger Car Association. And Harvard University is bracing for two bills in Massachusetts that could reshape its robust endowment and its legacy admissions policies. The first bill would hit Harvard and other colleges with over $1 billion in assets, with an annual 2.5% tax to fund state universities. The second would impose a fee on colleges that give legacy students an advantage when applying. Harvard didn't respond to a question asking for comments about the bills. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on this program, all eyes on the labor market.
I think the Fed's threshold for pain is higher than people are wanting it to be. I think that they do expect more cooling in the labor market, and they're okay with it. In fact, maybe even welcome it.
That's coming up next. Counting you down to the jobs report. It is about 16 minutes away. Live from New York City, this is Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Equities on the S&P 500 doing okay. Here's the why. Let's talk about the why. It's this one right here. It's Meta, up by 17% in the pre-market. Hardly talked about Amazon. That's doing okay as well, by the way. It's up by 7%. It's just two very different stories. You compare the success of Meta yesterday afternoon to the disappointment from Apple, just around what's happening with the iPhone on the mainland in China, what's happening with the overall business, Lisa. Down 13%. Over in China, the stock is down by close to 3%.
Even though it did beat on just in general top line earnings, I just want to point out we're not talking about Amazon at all. It's up 7%. Their market cap is $1.7 trillion. So we're talking about how, yeah, Meta's trading like a penny stock. It's up 17%. And this one, it's a, $1.6 trillion, $1.7 trillion market cap, up just a mere 7%.
What's her name? Tina. There is no alternative. US Tech, some of these names, it's pretty incredible.
Especially given the fact that they did cut staff. And I think it's important on Jobs Day, on Jobs Friday, Payrolls Friday, that we're talking about tech companies that have been able to cut staff and expand their revenues dramatically. Is this sort of a tea leaf of what's to come? Is this specific to these businesses? How much does this point to the churn that makes the labor market that much more difficult?
So what Mike Wilson talked about at Morgan Stanley, we spent the last year thinking about AI and AI enablers, NVIDIA. and not AI adopters. And that's when the job losses start to come to the table.
And potentially for investors, that's a positive thing because that means that they have more efficiency and they can actually invest in those companies. From an economy's point of view, there's going to be some turbulent times. How do you look through this kind of volatility in the data during a sea change technologically?
True. It is Jobs Friday, under surveillance this morning, all eyes on the labor market.
I think the Fed's threshold for pain is higher than people are wanting it to be. I think that they do expect more cooling in the labor market, and they're okay with it. In fact, maybe even welcome it to try to assuage the fears of a wage price spiral and all the other things that we worried about when the labor market was so tight.
Here's the latest this morning. The January payroll report due out in a few minutes' time attests to the Fed's wait-and-see approach. The median estimate in Bloomberg's survey calling for an increase of 185,000 jobs. Former Fed Governor Randy Kroszner joins us now for more. Governor Kroszner, great to catch up, sir. Let's get straight to it. How well is this labor market holding up in the face of 5.5% interest rates at the Federal Reserve?
It's been awfully resilient, much more resilient than I think the Fed or pretty much anyone had expected. Dramatic, rapid rise of interest rates. But one of the things that I think has helped to keep the labor market strong and the economy is strong is it's really only in the last 6 months or so that real interest rates, that is the inflation-adjusted interest rate, has become positive. So it's even though interest rates, nominal interest rates went up very rapidly, inflation rate was dramatically above that. Inflation rate has now come down quite a bit, but the interest rate is staying at around 5%.
Randy, can you tell me why you think that wage growth isn't running away, given how robust some of this jobs growth has been over the last 12 months?
Well, we certainly have seen much faster nominal wage growth, and that has persisted even as inflation has come down. So we're starting to see real wage growth, which is great for households, but probably means it's going to be less attractive for firms to be hiring workers. It was great when they could hire workers, increase with wages going up at 4%, but they were selling things at 8% more. Now they're having to pay 4% more for workers, but they're only getting 2 or 3% more for what they're selling.
How do you sort of put into perspective, given the fact that people are more expensive for a lot of these companies, the fact that we have heard all of these layoffs announced by a slew of companies, and not just big tech, across the board? We keep hearing about that. A lot of people are saying it's just churn, it's normal, it's layoffs that were put off during the pandemic. Do you see it as anything other than that?
Well, I think the labor market is softening a bit. The number of job openings have come down quite significantly. They're still pretty good. It's still a very strong labor market, under 4% unemployment rate. Although we'll see, maybe that'll switch today. I don't think so, but we'll see. And so I think there are some signs of softening, but so far very gradual signs of softening.
What would the threshold be for you? And we keep asking everybody this question, but what's the threshold that puts March back on the table for the Fed?
I think it'd have to be pretty devastating. The Fed has made it clear from their statement that they want to be confident that inflation is coming down to their target. I thought it was a very artful move that they took out the tightening bias, but didn't suddenly have the expectations be, oh, they're going to move next time. They said they took out the tightening bias, but said, we're not ready to move until we're confident. So I think they're going to wait to see have a fair amount of data. We've got this labor market report, the next labor market report. So I don't think this one will be dispositive.
Ellen Zena, Morgan Stanley, on a little bit earlier this morning, Lisa. She was pretty direct. You averaged 50K, which is very low. You averaged 50K across the next 2 reports. Inflation continues to soften. They might be there.
And people are trying to game that out, but otherwise, I mean, people are taking Powell kind of at his word in the sense that they're pricing out a March rate cut. So I guess people aren't really expecting that, but still, it would be a pretty high bar to cut in March.
Randy, I'm sure you watched that news conference. How did you react when he poured cold water all over the March meeting? What did you make of that?
Well, he's been trying to do that, and I think his colleagues have been trying to do that for a while. As I think we spoke about last month, I think he got a little bit over his skis in the previous press conference in getting people excited about a potential March move. And then he and his colleagues have spent the last 6 weeks trying to pull back from that. And I think it was quite clear that he said that they've taken out the tightening bias, so the next move is going to be lower, but it's not going to be imminent. I think this is very much like what happened when the Fed pivoted back at the end of 21, beginning of 22. It took them 3 meetings. In December of 21, they got rid of the transitory language. In January of 22, they said the move will come soon, and then they moved in 23. Here, they've just gotten rid of the tightening bias. I think what they will do is at some point, either in March or May, say that they have enough confidence to move soon.
Just real quick, Randy, it sounds like you don't think it was a mistake. We heard so many people come on the show and said, you know, say, hug the statement. Jay Powell, just hug the statement. We heard that from Bill Dudley. And then all you have to do is just stick to what the committee said. And it seemed like he was doing that. And then he was like, March's not on the table, really. We're not sure. I mean, you don't think it was an accident. You think he was actually reflecting what the committee was talking about and was deliberately trying to take that off the table.
Yeah, I think he and the committee members have been pretty clear in trying to take that off the table for the last, as I said, for the last 6 weeks, because I think there was a little bit of a mess up of communications in the previous press conference. And I think, as I said, unless there's something really pretty disastrous now, next meeting, and inflation really comes down, I don't think March is on the table. But I do think it's possible for May and certainly for June.
Randy, you do think that that was a bit of a mess up then, a screw up at the December meeting?
In December, I think he got a little bit over his, out a little over his skis. But I think they tried to pull it back, and I think yesterday was pretty clear that it's going to take an awful lot for them to move in March, and the probability of that is extremely low.
Message received. Great to catch up, Randy. Thank you, sir. Randy Crosnan there, the former Fed governor. With us around the table, Mike McKee, going into payrolls. 6 minutes away, Mike. What are you looking for?
I think one thing that is not completely appreciated on Wall Street, although some people have picked up on it, is we're going to get revisions here. We've already gotten revisions to the unemployment rate. Didn't make much of a difference, but we're going to get some revisions to prior numbers for payrolls back from 2019 to March of last year. So that could boost the level or lower the level of jobs previously. Plus, this is the time of year when we get the new population estimate, which will mean we can't really compare the household survey numbers to previous household numbers.
We were talking to Ellen Zentner, and she was noting how CPI was revised so dramatically last year. And we've seen these dramatic revisions to jobs numbers as well. People are now focusing more on this. Why are they so messy? Why are they getting it so much wronger, less correct than they have in the past?
Well, a couple of reasons. One is that, I mean, the payroll reports are always revised because they don't get all of the responses that they send out surveys, and then they can update it when they get new information. And the trend can tell you something. If they're all negative, you know, things are slowing down. The other is that the pandemic really messed things up in terms of the seasonal adjustment factors. And that's one of the things that went into the CPI revisions and may affect the payrolls revisions as well. Diane Swank at KPMG thinks that the seasonal revisions to December and January are going to give us a much bigger number than we otherwise would, because they've changed those, and the BLS has struggled with trying to come up with the right way to adjust these things.
Mike McKee, stay close. Did TK spike the drink this morning? Is that what happened?
It's Friday, so this is what happens when I can't work
Drop
from
by
home.
the studio.
This is what, you know, maybe you should send me home.
Sure. Payrolls report is coming up next. Equity futures positive by about 0.6%. From New York City, this is Bloomberg.
ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Here we go. 25 seconds away from the jobs report. The stage set like this on the S&P 500. Equity futures near session highs up by 0.6%. On the Nasdaq 100, positive by about 1 full percentage point. Going into the jobs number, we look like this in a bond market. 2-year, 10-year, 30-year. Your 2-year yield is higher by 3 basis points, 4.23. Your 10-year is unchanged at 388.73. With the jobs report, here's Mike McKee.
Well, the January pattern continues. Big gain in jobs, 353,000. This has happened the last 4 Januaries, except for 2020. 353,000 and 216,000 was the prior month's number. Let me see what we are revised from at this point. Well, I'll get that in just a second because it's buried in the data, but it'll come up in a second. Private payroll's up 317,000. Net payroll revision plus 126,000. So first, a positive in a while. Here's the revision to payrolls last month, 333,000. So a big revision higher in December, and this may be part of the seasonal thing we were talking about. Manufacturing jobs, 23,000, only 3,000 were expected. The unemployment rate stays at 3.7%. There was a thought that it might go up to 3.8, but that is 24 months, 2 full years of unemployment below 4%. Average hourly earnings, my goodness, up 0.6 on a month-over-month basis, pushes the year-over-year number to 4.5% from 4.1%. Average weekly hours fall to 34.1 from 34.3. Labor force participation unchanged, 62.5, and the U6 rate goes up a tick to 7.2. But the headline numbers are all really good, and I'm going to have to say...
Take a guess, Mike.
Anne-Marie, the White House has got to love this because they'll skip over the inflationary part.
Let's get straight to the price action, Mike McKee. Monster upside surprise on a jobs report, 353,000. The estimate 185. Equities off the high, still just about positive on the S&P by 0.25%. On the Nasdaq, up by 0.6. In the bond market, we're selling off at the front end. Yields are higher by more than 12 basis points, call it 13. On a 10-year, up by 7, 395. The dollar stronger, euro weaker. Breakdown on euro dollar, 108.39. We're negative there by 0.3%. Bramwell, we've got to talk about 2 things. Big upside surprise, yes, on payrolls. They'll be comfortable with that at the Federal Reserve. Would they be comfortable with this? Wage growth coming in much stronger than anticipated.
Exactly where I was going to go. This is not what they want to see. This really goes against the idea that you're seeing that sort of disinflation and gradual weakening or normalization under the hood. There is no sign of that here. The fact that you've got 4.5% year-over-year increase in average hourly hours, to me, is just a bit concerning for them, considering that that doesn't get you back down to 2%.
March is looking ice cold, isn't it, after that?
Essentially, it probably is going to be off the table unless something else happens, but yet it doesn't seem to be materially factoring into people's expectations of rate cuts for the remainder of the year. That's my question. Why does this upside surprise, that is a dramatic upside surprise, not factor into the overall full-year rate cut forecast?
And Mike McKee's going to keep chewing over this jobs report. We'll come back to Mike in just a moment. We've got Mohammed Al-Arian standing by, Bloomberg opinion columnist, president of Queen's College, Cambridge. Mohammed, let's deal with the wow first. What do you make of that?
Wow. I mean, what an amazing jobs report. It just confirms that this is an exceptional labor market that's going to feed into the exceptionalism of the U.S. economy. I do think it's a bit of a headache for the Fed because of the wage growth numbers. Lots of people have been warning about wage growth, about service inflation, and that just emphasizes that warning. And then finally for your markets, look, this means March is off the table. March should have been off the table for a while, as you and I have discussed, but this means March is off the table. It also means that you are more likely to get the 3 cuts that the Fed has signaled, 3 to 4, rather than the higher number that the markets has been romancing.
Do you think that May is potentially off the table too, Mohammed, given the fact that we're seeing wage pressures that are going in the wrong direction for the Fed?
You know, I was with you last week and I said June is what I think should happen and what I think is likely to happen. And that this report just feeds into that.
Mohammed, so what do you think it means in terms of the U.S. election? Can they cut closer to the election now, given March is off the table? What's the window they actually have?
So in a way, I'm going to ask you whether you think the Fed is influenced by politics. I tend to believe the view that the Fed is apolitical and that they will do what they think is right. For the administration, this is a two-sided sword because on the one hand, it is good for them that the economy is doing so well. On the other hand, there is concern that as you get closer to the election, you're going to start getting the weakening that results from buffers, balance sheets having been used to power this economy. So, you know, it's good news for them right now, but I think that they have to keep an eye to what's going to happen closer to November.
I'm looking through these numbers, and the revisions are just sort of stunning as well. I mean, everything is just being revised up to the upside, also just coming in hotter than expected. Mohammed, what do you make of that? The fact that people are getting it wrong, and they're not getting it wrong for the weakness. They're getting it wrong for the incredible strength under the hood that's behind some of the strength that we've seen so far.
And that has been the consistent story, Lisa, for the last 18 months. You know, I keep on reminding people that going into 2023, the consensus was recession. We ended up with a nearly 5% growth rate in the third quarter, 3.3% in the fourth quarter. Estimates suggest that strength remains. And pending corrections from Mike McKee, who's looking at the details, this at first sight, and I just had a very quick glance, looks like a very broad-based strength. So this is not something that you can easily assume away. This is something that you have to take seriously. This economy is still strong in a broad base.
Mohammed, stay close. If you are just joining us, blowout jobs report. The number looks like this, 353. The estimate, 185. We were looking for unemployment to climb just a little bit from 3.7 to 3.8%. It stays at 3.7%. The big surprise, and I think maybe the unsettling data point for the Federal Reserve, is wage growth coming in at 0.6% month on month. The estimate 0.3. That takes us year over year to 4.5. The estimate and previous number 4.1. Let's work through the price action, starting with equities. On the S&P 500, positive by 0.1%. On the Nasdaq, still up by 0.4. We were up 1 full percentage point. Bear in mind, there's some big moves in the pre-market by some mega tech players off the back of some stellar earnings. The Russell, perhaps the read on what's happening here, the Russell is negative by 1%. In the bond market, switch up the board and check out the 2-year, up by more than 16 basis points on a 2-year yield. 436.79, up 9 on a 10-year, 397.24. In foreign exchange, the dollar a whole lot stronger. The euro just about holding on to 108, 108.13 on euro dollar. Mike McKee, you've had some extra time to go over this one. What stands out?
Well, on the revisions front, big revisions in terms of jobs, the non-farm payrolls part. Most of the last year revised down significantly, but the last couple of months of the year revised up by an average 27,000 a month. So the economy was adding jobs at a faster pace during the latter half of 2023, which just goes to show that we have not slowed down here, and the recession call is not working. Interestingly, looking at the jobs breakdown in terms of where jobs were, I mentioned manufacturing 23, construction 11,000, service providing jobs was where the action was, 289,000 service providing jobs, and of those, professional and business services went up 74,000. That was a category people were worried about because it went down some in the prior month, and that's usually a harbinger of what's going to be happening in the economy. And here's something I haven't been able to say for quite some time.
Say it, Mike.
Eating and drinking places lost jobs during the month of December.
Interesting.
Very hard to figure out why, but the food and drinking places lost 2,400 jobs. Overall, leisure and hospitality was up, but that was mostly an entertainment stuff.
You know what the former president would do with a jobs report like this, Donald Trump? Rose Garden address. He'd get everyone out there, you'd have balloons, he'd talk about how strong this jobs market would be. What would they do?
Hats. There'd be hats.
Hats?
Yeah.
Right, with the number on top?
100%.
Totally.
It is unfortunately a bad day for Joe Biden to do that, given what his other commitments are today. He's going to Dover, I guess, to welcome back the bodies of the servicemen killed. So it's kind of hard for him to take a victory lap, but I would imagine that they are very happy at the White House.
Mohammed, let's turn to you, sir, and get your thoughts on the Federal Reserve. You mentioned, Mohammed, that maybe June was going to be the date for you, and March was too soon. Mohammed, what guided that thought to believe with, and to begin with, and obviously this data backs that up?
I think three things, John. One was the data, that the economy wasn't going to weaken as fast as people who opted for March thought. Two was just pure risk management. It was really important to realize that this is a Fed that does not want to make another mistake. You know, the list of mistakes is already long, as is the list of communication mishaps. And this is a Fed that recognizes that it's getting back on side and would not mess that up. And then the third issue is the dynamic of the inflation itself. This has not been a broad-based disinflation. This has been a disinflation led by the goods sector, and there's a limit to how much the massive disinflation of the goods sector, in fact, deflation in some cases, can keep you going. You got to see services disinflation accelerate, and we simply have not seen enough.
We also are starting to see a re-acceleration in the manufacturing space. I'm thinking about yesterday's ISM manufacturing data showing prices paid accelerating at the fastest clip since December 2020. And then I'm looking at this, manufacturing jobs. There were 23,000 that were added in this latest payrolls report versus the 3,000 expected. Do you see signs that what you see is the manufacturing sector catching up to services, not the services going down to manufacturing?
So that's the worry if it happens in prices. If it happens in activity, that's a huge relief because you get this continued immaculate disinflation that we all want. We don't want to sacrifice growth too much. So if it happens in activity, that's great. If it happens in prices, that's the concern that people have. Look, I haven't even referred to exogenous issues. You know, my view is that we are now living in a global macroeconomy with insufficiently flexible supply. And we're getting evidence of that on a weekly basis. The one number that's a disappointment in this report is labor force participation. We all want higher labor force participation. We want the supply side to enable this immaculate disinflation. And unfortunately, we didn't get higher labor force participation.
Mohammed, do you think that it was a policy error for the Federal Reserve to remove the idea of a rate hike from the table?
Interesting one, Lisa. No, I don't. I think the mistake, honestly, is in how they communicate. You and Randy Krasner were talking about the communication mishap in December. I view what happened on Wednesday a communication mishap. The statement that came out of the FOMC was very well drafted, was finely crafted, and gave them what they want, which is the optionality. The sudden pivot in the press conference to March is off the table was unnecessary and unhelpful, to tell you the truth. Look, I agree March is off the table, but if you have a statement that gives you optionality, you stick to that statement. And I agreed with the speakers you had on Wednesday that he should have hugged that statement. It raises all sorts of questions in terms of volatility during these press conferences, in terms of who do you believe, who is the chair speaking on behalf of? Is he speaking on behalf of something that happened in the committee that we weren't told in the statement? Or is he speaking on his behalf? You don't need all this noise when the Fed should be signaling, because ultimately it will weaken the Fed's signals, and that would be detrimental to good policymaking.
Let's build on this and bring in Jeff Rosenberg, portfolio manager of the BlackRock Systematic Multi-Strategy Fund. Jeff, great to catch up with you, sir, following the Fed decision on Wednesday. Let's do it again this morning, following the data this Friday morning. Your response to this one, Jeff, just a blowout jobs report.
It is at first blush, Jonathan. You often say the first reaction is not the last reaction. So just a couple of things to consider here in terms of this first reaction. You know, number one, and I think it's been mentioned already, in terms of headline payrolls, there's a lot of seasonality in this number. If you look at the spread of expectations, it's one of the widest expectations spread of any month. This is, I think it was mentioned before, you know, consecutive January upside surprises. You have a lot of seasonality effects that may be overstating the strength in that payroll number. Number two, in terms of AHG, I think you have to be a little bit careful about reading too much into the big upside surprise on AHG. A couple things going on there. Number one, you always have a mix shift. Mike McKee went through the mixture of the jobs. A lot of that, what you saw there was that the lower end paying jobs were actually not as large of a contributor as the higher end. And additionally, the reduction in the work week also flatters the AHG number. Much more important is what we got earlier this week in terms of ECI, kind of validating the disinflation in terms of wages. So not to take anything away from the initial reaction of this is a very strong report and a strong labor market. And what that does is it's less about kind of, Lisa, interesting question, agree, you know, should they be tightening? No, there is a pace here for normalization. It's just not as quick as what the bond market was expecting, and it's not as soon.
Jeff, the takeaway from Wednesday's news conference for many was this Fed would embrace stronger data, and if we weaken, they'd be able to step in and reduce interest rates perhaps sooner. That reaction functioned far more market-friendly. Is there anything about this story that changes that in any way, shape, or form?
I think it reinforces it, you know, in kind of thinking about what the market reaction would have been, upside miss, downside miss. I think we're right along those expectations. Stronger than economic data, that's good news. This economy is strong. But I think what it pivots is that the Fed doesn't have to normalize policy as quick. You know, you asked me a couple of meetings ago, my expectation, my answer was June. What's the rush? Similar to what Mohammed just said, there's not a rush if there's not an economic slowing. And I think as you see the strength in the economy, the pivot in the focus of the market and the conversation is going to move away from inflation. We've kind of won the battle on inflation. Still a debate as to where that settles in, but much more about how strong is this economy and what that tells us about what the Fed continues to believe and say. They think they're restrictive, but if the economy stays well above potential is what we've been at, then you got to question where that restrictiveness really is. And that really calls into question the longer term path of expectations of Fed cuts this year.
Which is exactly why I'm wondering, and I'm interested in the sell-off in the 10-year yield up almost 10 basis points. Does this make you, Jeff, not like longer term bonds nearly as much?
Well, we've always had, not always, but in this cycle, more of a preference for the front end of the curve. A number of reasons for that. But to answer your question, yes, it just reinforces the skepticism we have in terms of long end duration in portfolios playing the role that it used to. You know, flight to quality used to mean you buy the front end. And now I think that's what it means again. So for investors looking for that ballast in their portfolios, it used to be you wanted to own the back end. Now you want to own the front end because that's where most of the interest rate declines are going to occur. And that back end is vulnerable to an increase in term premium, inflation premium. And I think that's what you're seeing here today as well.
Mohammed, will you agree? Because I know that you do think that structurally we're headed toward higher inflation. Do you think that almost the Fed is embracing that in sort of this sort of subtle way, and you're going to see that increasingly priced in?
Embraced it yet. I hope at some point it will understand it. What Jeff just said is really consequential, because it means that our traditional reliance on longer duration bonds as risk mitigator is less effective. That is a really consequential statement, because it raises the question of what else can play that role. You can't get as much risk mitigation from the front end. So this is just, it tells you how complex portfolio management has become as we normalize in a world that has issues on the supply side.
Going forward, I'm wondering, Jeff, what you're looking for to understand and whether it's relevant to you, whether the Fed's going to cut rates in May or June. How far ahead of an election cycle, how far ahead of economic data actually turning do you think they need to really get?
Well, they want to get out in front of inflation. Powell said very clearly, we don't want to wait till we're already at 2%. On a 6-month annualized basis, they're at 2%. They want to see that in the next, so many months. That's what we talked about on Wednesday. They want to be validated in terms of not making a mistake on inflation. And those are the maintenance cuts. And the maintenance cuts are, inflation has come down. You don't want real interest rates to go up, so you maintain the real policy rate by cutting rates. I think that's most of what the Fed is signaling. The bond market has gotten ahead of itself in expecting calibration cuts, meaning they think policy is too tight, the economy is going to slow, and therefore the Fed's got to start to cut. Nowhere do you see that in any of the data, especially in today, again, reinforcing the notion that policy may not be restrictive. And so you don't need the 5 to 6 cuts that the bond market is pricing in. And so bonds got to take that out. And, that's problematic for the valuation side of financial markets because they like lower interest rates, not higher interest rates. So we're going to have to calibrate that and work through that.
Well, let's get into that. Let's talk about what's happening with markets right now. Let's park payrolls, stellar jobs report. Let's look at one single name, Meta. In the pre-market up by something like 17%. Jeff, what is going on with the valuations of some of these markets? The fact that we've got rates up to 5.5%, the credit spreads are still pretty tight, the equity markets are at all-time highs. What is going on with financial conditions?
So broadly, financial conditions are easing. I think we got to be really careful about looking at the stock market, looking at Meta, looking at the Magnificent Seven. They're in a different stratosphere. They're operating more off of the numerator than they are on the denominator, meaning earnings and earnings growth are so powerful for those stocks. They're perceived as secular growers. They're almost treated as defensive and flight to quality insurance in the equity world because of that persistence of growth. And I think that's the Meta story here again this morning. I think you got to look away from those stocks to see underneath the surface what's going on. I think you mentioned earlier Russell 2000. That's a much better economic barometer of growth and inflation and interest rate sensitivity to see what's going on there. So you separate those two things out. And for the rest of the stocks, there's a lot more denominator effect because the numerator side in a slowing nominal GDP environment isn't powering those stocks and powering those valuations through. It's much more about what's happening with the path of the underlying discount rate.
Mohammed, what's your view on the same thing? What's developing in financial markets and financial conditions?
Well, first, let me tell you, my reaction to Meta was what you said earlier, that you don't expect a 17% pop on an earnings from a company that large and that well covered. And that in itself, it tells you something about what's happening in the market place. Look, financial conditions have loosened a great deal. November, December was a wonderful gift to financial conditions, a wonderful gift to investors. And I think that we're going to take some of this back in the next few weeks.
Mohammed, how much of that is tied to the idea of interest rates remaining high for longer? A lot of people now questioning whether we can just live with 5%, 5.5% benchmark rate. Do you think that that's going to be called into question as time proceeds?
The other day I was talking about a stock versus flow issue. On a flow basis, you would be very constructive on the economy and you would be constructive on the market. But that's a stock. That's what we bring into 2024. And we bring in two things. One is the resilience of balance sheets is lower. And secondly, you have a small but consequential set of asset classes that have not yet adjusted sufficiently to the new interest rate reality. So every once in a while, we'll have a concern about banks. Every once in a while, we'll have a concern about commercial real estate. There's going to be issues about private equity valuations. And over again, the question is going to be, will you have contagion? Will you have contamination? So we have to get over this stock issue. I think we can, as long as we don't slip on the flow issue.
Jeff, what's your take on that?
I think Mohammed brings up really important points. And, you know, you look back at the New York Community Bank issues, and it is really about this underlying commercial real estate uncertainty and the adjustment to higher interest rates. And I think he's absolutely right. I think there's a lot of resilience more broadly when you look at commercial, when you look at consumer. It was the benefit of having 1-2 years of zero interest rates and the actions that players took in that environment to secure their balance sheets, to extend debt maturities. They've mitigated a lot of the interest rate sensitivity. But as Mohammed highlights, there is the risk out there. And when investors kind of get all in and technicals get overbought and you have that vulnerability and then you have a little spark, you can have some of this pullback. And I think that's what we're seeing here in financial markets.
Mohammed, just to give you the final word, is June still the day, the month for you, for the Federal Reserve to cut?
I think so, yes, John.
Mohammed, appreciate your time, sir. As always, great to catch up with Mohammed Al-Arian there of Queen's College, Cambridge, and Jeff Rosenberg of BlackRock. Let's just finish on the numbers and wrap it up. Bramo, 353 against an estimate of 185.
And not just that, but an upside revision to the previous month, really seeing an average of 27,000 new jobs additionally added in the 3-month trailing average. Average hourly earnings coming in at 0.6% rather than 0.3% for an annualized 4.5% gain in wages. This is not a picture of a weakening labor market.
It's a pretty incredible number for this White House to go around talking about AMH for the next month or so.
Absolutely. 2 straight years now of unemployment rate 4% or lower. This is something they can really win on. The issue is when you look at the polls, Americans continue to say, while they are still starting to feel a little bit better about the economy, they're worried. They still are worried about inflation and price pressures, but also they just don't trust Biden on the economy. They trust Trump more. At least our polling shows that in the 7 critical swing states.
Those polls just aren't changing. Consumer confidence starting to turn around just a touch, 353 is the number, 185 was the estimate. 3.7% on unemployment, wage growth coming in hot at 0.6% month over month, year over year at 4.5. Coming up on Monday, we'll be talking about this jobs report with Laurie Calvasina of RBC, the OECD chief economist Claire Lombardelli, Ed Yardeni of Yardeni Research, and Subhadra Japa of SocGen. From New York City, for our audience worldwide, have a wonderful weekend. Counting you down to the opening bell with equity futures positive on the S&P 500 just by 0.1%.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships. And you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always going to be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrell. We've moved from being blinded by the light of tech to blown away by the jobs report on these markets. Countdown to the open, it starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrell.
Coming up on the show, U.S. payrolls come in hotter than expected. Apple earnings spoil the big tech parade. And Donald Trump throwing shade at Chairman Powell. We begin with the big issue. It is Jobs Day in the USA.
Wow. I mean, what an amazing jobs report. It just confirms that this is an exceptional labor market that's going to feed into the exceptionalism of the U.S. economy. I do think it's a bit of a headache for the Fed because of the wage growth numbers. For the markets, look, this means March is off the table.
March is off the table. Mike McKee joins me now. Here's a time to dig deep into this payrolls report. Mike, good day.
Good day, and a very good day to be looking for a job, perhaps, because it looks like there's a lot of them out there. The change in non-farm payrolls exceeding the highest estimate by anybody at 353,000, and we were looking at the number for the month of December revised up to 333,000, 2 months in a row, with job gains over 300,000, net revisions of 126,000, most of those, as you heard, in the month of December. Unemployment stays at 3.7%, in part because the participation rate went down a tick, but it just shows that there is still a lot of strength in the labor market, because that's 24 straight months, 2 full years of unemployment below 4%. The number that caught everybody's attention, average hourly earnings up 0.6 on the month, pushing the year-over-year number to 4.5%. But that happened back in January of 2022 as well, and the next month they gave it all back, had a flat reading. So we'll see if it's just an outlier, in part because hours worked went down a little. You can see the revisions there. These are the months for the revisions. Big kind of revision in the total number of January to March 23 jobs, but that resulted in a stronger last half of 2023. The rest of them, not much of a difference maker. Where the jobs are, service providing, again, big 289,000. Manufacturing, a lot stronger than people anticipated. The forecast was for 3,000 jobs. Professional services, which includes employment agencies, that one had come in weak in recent months. It rebounds nicely there. And this is, man, it's the first time in many months I can report that bar and restaurant hiring actually went down Can't explain why. Now, this is the fourth out of the last 5 years that we've seen this big kind of jump in January. And here's the reason why. The non-seasonally adjusted numbers, as you can see, fall sharply every January because all the people who were hired for the holiday season extra work get laid off, and then the seasonal adjustment factors wipe those out, and that's what happened again this time. We did lose jobs on a non-seasonally adjusted basis, not as many as in the past, which is one reason we saw so much strength in the seasonally adjusted numbers.
Mike, no doubt about it, it's a wow from everybody all around. Mike McKee there, drilling into the food and beverage business as well. Let's continue the conversation. Now set the agenda with BlackRock's Rick Reeder. Rick, good to have you with me. Mohammed El-Arian went wow. He took monosyllabic. Here we are. This is a red-hot economy. What's your superlative?
So, yeah, I think it's, by the way, people spend a lot of time talking about soft landing. I heard somebody say soft landing lead to hard landing. I actually don't think I actually don't think satellites really land. Like, I don't think this economy, it's a service-oriented economy, like Mike was describing. And you look at in this report, you look at things like healthcare and education, not really cyclical. We just keep growing there. You look at professional business services, pretty darn impressive. So service-oriented economy. So I know I've used this stat before. In 100 years, service-oriented economy has only had, I think, negative 13 quarters, the service component of the economy. I think people spend so much time talking about manufacturing, but in a new economic paradigm that we have today in services, it's pretty darn solid, and today was no difference in that.
So the market finally may well come to heel. The market is 5 to 6 rate cuts. The Fed is at 3 rate cuts. Do you think that this data, factual data, will close that gap materially? Look at the short end of the curve. I know we've had some idiosyncratic moves this week with regional banks. We'll come to that in a moment. Does the gap now need to materially close? Does the market need to come to heel?
So I think the market, it started in November, December. The market got super overzealous. Let's say inflation data has come down. That's significantly better. But the market was, I don't know why the market thought the Fed was lying for as long as it was. So yes, I think you're coming closer to reality. That being said, if you take the real rate and where the funds rate is today, the Fed needs to bring the rate down. Are they going to do it? I still think they're going to go in May. You maybe took the odds down a little bit, but the market's predicting they would go in March. I think that was crazy from the beginning, and obviously it's pretty off the table today, as Mohammed said. The one thing I would say, I still think this Fed can get 3 to 4 hikes done this year, and I think they will. And so I think the markets settle in around those numbers. I think it makes sense given where the real rate of interest is. And listen, people will talk about this earnings number, this average hourly earnings. Mike McKee said it right. You have to look at the hours number because that flattered the income on the other side of it. So I'm not that worked up about wages that will preclude the Fed from still being able to cut rates again as you get into May and June.
And that unemployment rate, though, Rick, below 4%. I mean, I'll get Mike to fact check me. I think that's 24 months in a row. That's the longest run since 1967. Great year, Rick, for 67. I was born then. But on a slightly more serious note, I've had Ian Lingen here this morning saying, man, we're still going to see bull steepeners in this bond market. But maybe that's challenged on the back of this, because you might not just get as aggressive a rate-cutting cycle as the bull steepener protagonists want.
So I think there are two parts of it. By the way, I was a toddler in 67, so I was barely. So I'd say a couple of things to that end. Listen, I still think the curve's going to steepen, but like you say, it maybe needs a little time to marinate a bit with the data that we're seeing. Listen, I thought it was a really important point that Chair Powell said in the press conference. He talked about growth, and he said you got to separate out growth from their mandate. The mandate's full employment and price stability. If you're running full employment where you are, and price stability is happening. We think core PCE is going to be in around 2.3 over the next couple of months. You're getting pretty darn close to target. You can start reducing the rate. The curve can steepen. But like you say, it needs a little bit of time to mature and, going forward. And by the way, the demand for long-end interest rates, the demand for yielding product in the markets is so profound today that I think it keeps the whole curve in pretty good shape for a while. Again, a reasonable readjustment today, as I think it should, particularly in the front end. But I still think that the need for fixed income or the desire for people to get these yields is going to be there for a while.
You're a good man. So we're marinating the steepener. And it's a bit like going to a barbecue with Rick Rader, isn't it? Look, I know you're a natural proclivity to buy bonds. You're an evangelist of that. So when I get a nice spike, even in the short end, you know, somebody was talking me through ladders yesterday, which sort of like, ooh, okay, I need to understand that. But, you know, at moments like this, Rick, is this where you still get the opportunity to take on additional sovereign and credit?
So by the way, evangelist is better than I think the vigilante term I think that's out there. So I'd say a couple of things. You think about where we're funding companies today, and by the way, I'll go to Europe, which is the more extreme version of it. Do you know we were funding 80% of the companies in the front of the curve at negative yield if you go back a couple of years ago?
It's beautiful, a beautiful thing.
We're lending companies money here. Just take it at negative yields. Now, if you're an investor in these bonds, particularly if you're a dollar investor, you're getting 6%-ish, depending on where you are. If you're high yield in Europe, you're getting 8-ish. And then, you know, in the U.S., you're still getting 5.5, 6, 6.5, depending on where you are in the credit rating. Those yields to fund companies who are in better shape from a credit perspective than arguably they've ever been in because they termed their debt out when rates were at 0 or negative. So listen, I like buying yield. Like, I think you just sit on this yield. The Fed's going to cut rates. There's no emergency today, given where we are. But this is a really different dynamic than last year or the year before. Buy the income, sit on the income, it'll work for you, and credit's in great shape, and you know, securitized assets are in good shape, mortgages are in good shape. I think going in this yield, I think people will feel when you wrap up 2024, God, I got a really good term, I got a good return in fixed income, and by the way, I think I'll have a decent return in equities, but augmenting it with more income, I think is going to be the right trade for 24.
I'm hoping so, because I'm all in on this whole American dream thing, Rick. I've got the 60-40 portfolio going on, and we're just about to deploy. So we must be near the top of one of these markets. Now, we had a regional bank anaphylactic shock moment this week. Nobody was expecting it. Big shock. Commercial real estate's got a problem. But the bond market went bid. 2s and 5s. 5s the lowest since June of last year. A salient reminder that there is idiosyncratic risk or something more protracted in commercial real estate. For you as a house, do you see it as idiosyncratic risk or something more pervasive that I should be wary of? Because the market just bought bonds and didn't bother to ask any questions. For you, your upsum on regional bank, idiosyncratic or something more malevolent?
So, listen, I think more idiosyncratic, but I think you have to, the markets are super sensitive to what happened and the impact that had on rates, the impact that had on the broad financial system. So I think you have to respect that. I think the market's got a little overdone on that. Listen, I think there's something that's really important around this. There are, I think the number is 4,750 banks in the U.S. I think the country with the second most banks is Russia or the U.K. at 300 and something. There are a lot of local banks in the United savings and loans, credit unions. My sense is there's going to be consolidation. It's really hard when you fund yourself at these high levels of yield and your earning assets are significantly below that. There has to be some consolidation. There are, you know, there's going to be underwriting dynamics that are difficult, particularly in commercial real estate. So, listen, I think you're going to see a consolidation of the banking system. I think it can happen in a relatively stable way. But if you said to me, this is the last of these sort of events globally, including Japan and otherwise, for lending that happened in and around commercial real estate, I don't think this will be the last one. No way this is the last one. And by the way, it will make people nervous, but I don't think you're talking about systemic shock.
Okay, well, maybe it's healthy, and let's hope that if it is consolidation, it's consolidation through mutual consent rather than crisis. Rick, good to have you with me. Look forward to the barbecue and the marination of a steepener. Okay, that's the agenda in the bond market. Let's move ahead and talk about stocks. Abigail Doolittle is side by side with me this morning. What have you got? I mean, look at that Meta. Bang, bang, bang.
Yeah, that Meta is really an eye-opener when I saw that 17% gain, but not going to the upside. We do have Apple down 3.3%. In fact, if it stays down into the open, it will be down 7 out of the last 8 days. Right now, down 6% year to date. They put up a solid December quarter, but beneath the surface, the China slump continues. 20% of revenue last year, plunging 13% last quarter. Not offset that fear around that by the first quarter of sales growth in about a year. Meta, though, So there you go, 16%, gaining by 16% in the pre-market. They beat their fourth quarter. It was described as spectacular by one analyst. The outlook was up solidly, and they did, of course, announce a $50 billion buyback to entice new investors. And then Amazon up 6.4%. They reported strong sales. It was the strongest online e-commerce quarter since the pandemic. Their operating income outlook is rosy. It looks like some of those cost-cutting efforts are in place and helping out that bottom line for the year ahead, Manus. The shares of Amazon, again, up more than 6%.
Okay, Abby, thank you very much. Stay with me. We've got more work to do together. Coming up on the show, it is big tech. It's delivering mixed results.
They are starting to lose share within the China market. At the very least, replacement cycles are slowing within China.
Meta and Amazon impress. Apple disappoints. That conversation with Crossmark's Victoria Fernandez and PGIM's Michael Collins with me next, setting the stage for Risk this Jobs Friday.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
They are starting to lose share within the China market. At the very least, replacement cycles are slowing within China. Outside of that, the results were actually very, very good. I mean, you pointed to the growth in Asia, grew about 7%. Apple very underpenetrated in most markets outside of the U.S. and China. Actually, they've only got 20% of the global share of the smartphone market.
Apple posting weaker results out of China despite the total iPhone sales topping the estimates. The CFO says this: "We are not happy with the decline. We know China is the most competitive market in the world. We continue to see significant opportunity for us in China in the long term." Wonderful PR statement. Meanwhile, it's another story for Amazon and Meta, both surging. They beat earnings expectations. Katie Greifeld is with me. So it's bid me up for Meta. It's stupendous, isn't it? Apple, nothing to worry about in China. It's only a $3 billion drop.
Yeah, you take a look at the reaction in the market this morning. It's really the have and the have-nots from last night's tech earnings. Let's start with the bad news. We'll start with Apple, of course. Those China fears really making a dent in shares this morning. Let's go through some of the actual numbers. You had sales in China drop 13% 20% in the fiscal first quarter to $20.8 billion. That is far short of what analysts had been looking for, about $23.5 billion. That amounts to the weakest December quarter in China since 2020. Not a size and scope you want to see. That was overwhelming. Otherwise, strong results in most product categories. Total iPhone sales stronger than expected. Apple also returning to revenue growth, but shares down this morning. Different story, like you said, for Meta and Amazon. That comes down to the cold reality of capitalism. Shareholders really rewarding those cost cuts, those layoffs, and that's in addition to strong earnings, which of course also helps. So Amazon, obviously, you can see rising there by about 6%, but I really want to talk about Meta. Really interesting report, a $50 billion buyback. Also, the company putting in place its first ever quarterly dividend, going old school there. And Mark Zuckerberg, he actually stands to get about $700 million a year from that dividend. That is according to data compiled by Bloomberg. Shareholders celebrating as well. Double-digit gain on Meta so far this morning. Before the bell, the market hasn't even opened.
Yeah, I like that. Cold reality.
The cold embrace.
That's us.
Yeah.
Katie, thank you very much. Katie Greifeld there, taking us through some of the moves. Joining me now to discuss risk, it is Crossmark's Victoria Fernandez and PGIM's Michael Collins. A lovely phrase from Katie there, the cold reality. And the cold reality is this: that jobs report just wiped out March for a rate cut. But does that really, really upend risk in any way? Victoria, to you, good morning, because I mean, there's an exceptionalism in some of these tech reports over the past 24 hours. To you, first of all, March is off the table, but we are blinded by the light of tech overnight.
Yeah, well, I think March has been off the table, at least for us it has been. It's what we've been talking to our clients about for the last few months, is that we never thought the Fed was going to make a move in March because there's so many different elements out in the market right now that are kind of pushing and pulling at each other. So you look at tech earnings earlier in the week, we actually saw the NASDAQ pull back pretty significantly after Alphabet's earnings and Microsoft earnings. And now we had this reversal here at the end of the week because of Amazon and because of Meta. You combine that with what you're seeing in the jobs report that you mentioned, and you say, wow, look, the economy is really strong. We've got over 300,000 jobs in this report. But at the same time, you can say, but wait a minute, average hourly earnings are up 4.5% year over year. You look pre-COVID, and the average high level was around 3.5%. That could put a lot of pressure on margins, and we can talk about that in regards to earnings. So I think there's a lot of kind of what ifs out in the economy right now. There's some people that are risk on, some that are being a little more cautious. That's what's causing the volatility in the market. But obviously, the last couple days, tech has been the driver of this market.
Look, it absolutely has. And I think once we clear the decks with this week, Victoria, we will begin to look at those margins again. Michael, good morning. I just had Rick Reeder with me. He's marinating over his steepeners. But of course, the backup in yield that you see today is perhaps an opportunity. Is this the kind of action day where we're going to see flow into bonds by the close of business?
Yeah, man, this is actually, as Rick said, not a bad place to be for fixed income investors. You know, interestingly, we've been getting a little nervous and disappointed that we had such a big drop in yields, you know, from 5% last fall to, you know, into the 380s so quickly. And we're concerned that a lot of our clients, who we've been advising, frankly, to leg into the duration trade, continue to leg into fixed income, that maybe missed a big part of the rally. And now this gives us another bite at the apple, right? So our advice has been, you know, you get that 10-year into the fours, between 4 and 4.5, and you're in the buy zone, you know, in the low.
You're in the kill zone.
Mid-threes, you're probably in the sell zone. So I think this is actually good that you can earn this yield for a longer period of time.
I mean, look, two very different asset classes that we got to talk about. Michael, you know, today we're fully effusive, fully bullish on Meta, Amazon, etc. And nobody seems to be bothered remotely about Apple's disappointment in China. I mean, 3% is hardly what you call rocking it on the downside. You warn, though, that the Fed could keep us too high for too long. Really?
Yeah, I mean, that's really the big risk over the intermediate term, man. It's in the near term, the economy certainly seems to be firing on all cylinders. I mean, you really have to squint
to see the cracks in the system. If anything, we're just going through these kind of rolling sectors that are slowing down. I mean, consumers boomed last year, industrials lagged, and it seems to be rotating the other way this year to some extent. But that was predicated on the notion that rates are going to be lower, you know, in the next year or two. And I think the risk is that the Fed is too slow to react, and that's their MO historically.
All right, well, look, you know, on the way up, it was ramped up, but late. Let's see how delayed they are on the way down. Victoria, let's close it off. I mean, one of the monikers this morning is that 2023 was a year of efficiency within big tech, and this year is going to be the year of reward. Briefly, do you begin to take some people out of the Mag 7 in 40 seconds?
So, Manus, we've been taking people not completely out of those names, but trimming those names. We're a firm believer that as these names were making highs, as they continue to move higher over the end of last year, even beginning of this year, to trim some of those names and put them in other places. We're looking at financials, we're looking at healthcare, other areas that had been a little bit beaten down. You're starting to see some relative leadership there in those sectors. So we would trim some of these names, put your money to work in other places, even including fixed income like you and Michael were speaking about.
The two of you can agree to have lunch then together. Victoria, Michael, stay with us. We've got more work to do out of the two of you on this jobs day. Morning calls a little bit later. We're going to talk about Apple spoiling the big tech parade. Mid-weekly results in China. That conversation just ahead of the opening bell. Don't miss it. This is Bloomberg.
There is no digital without chips, and I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
We're counting down to the market open. The disruptor is this, a blowout jobs report, which takes the two-year yield spiking higher by 16 basis points. That's what challenges the velocity of the equity market. Two's up by 16 bips. This is a blowout jobs report. Wages are roasting hot, and the question is, what does that do to the Fed? It kicks March to death, and it takes May, maybe even a little bit later in the year, to see these cuts. 12 basis points higher on the 10-year yield. Morning calls for you. This is what you got from the street. You've got some big recommendations out this morning. Citigroup upgrading Macy's to neutral, highlighting the stock's improving risk-reward. Deutsche Bank downgrades New York Community Bank to hold, saying there's just too much uncertainty in the credit quality.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
At the ETF of JP Morgan Asset Management. You can see that a big crowd has turned up. The question is, what happens to these markets next? You've had a blowout jobs report, but yet you have the drag from Apple, the drag from Tesla, battles against Meta, barnstorming up by 18%. That is all about AI in the future. Futures are set for a rise, but the injurious point to the equity market rally this morning is the bond market. Twos are up by 16 basis points because March has been annihilated in terms of a possible rate-cutting cycle from the Federal Reserve. Focus on the two-year yields, up 15 basis points at the moment. We're moving higher across the curve. We've just had Rick Reeder with us there saying that the steepeners are being marinated. Crude down by 1.5% this morning, and the euro dollar, that is the euro down and the dollar bid by 0.6%. With the spike in yields, so goes the dollar goes bid, euro goes offered. And again, it is the differential between who will cut first, i.e. Europe, relative to the United States of America. It is about rates and a little slither of Roro. Let me take you through the market open. I mentioned Apple at the start, and it is a weaker set of numbers on China. That overshadows an otherwise strong set of results on the iPhone, along with services. Ed Ludlow is there to tell us why the market should be more focused on China.
Well, the market's disappointed in China. As you know, CFO Luca Maestri spoke with our own Emily Chang and said, we are disappointed with the decline in sales in Greater China. They missed the mark in that market by a $3 billion margin, while overall growth did return. So very minimal growth on the top line. They exceeded overall sales by $1 billion. What I'm trying to understand is the stock's down 3.5%. Is what are kind of incongruous and mixed messages about the iPhone in China. So the CFO of Apple tells us we're disappointed with the decline in Greater China. But if you go to the transcript of the earnings call, right at the top of his opening remarks, he cites third-party data from Kantar that they use to argue that in China, in urban China, Apple claims 4 out of the top 6 spots on the handset market. So this is a line they've repeated in the past where they basically say the weakness in China doesn't relate to iPhone, and iPhone is everything in this context. Overall, iPhone sales beat in the quarter. And they've leaned into the idea that it's a lack of new refresh or new products on the Mac and iPad line. So I don't think we came away with a big understanding there. That said, one area the street is really focused on is the global growth in installed device base. Across all Apple devices, people around the world who have a phone, iPad, Mac, wearables, whatever, that number continues to grow impressively. And they also went some way to address the concerns about upcoming regulation in Europe, with which they have to be compliant in the context of software and online store. 7% of those online store sales are from the European Union. So the market's down 3%, the stock's back to where it was in November, a mixed bag. But if you look in aggregate at this earnings season for mega cap tech, it's been a long one, and it's not even really got going yet. Apple's probably the laggard in that magnificent group, right, Manus?
Yeah, I mean, I look at some of those lines. I was on the T-Live yesterday evening at home. I mean, they in Apple, they say China is our most competitive market. And then there's a lovely reflection by one or two of the analysts, Ed, which is they take you back to HP and Dell in the 2010s. That's the beginning of the long goodbye. I don't think anybody's saying that about Apple today, but maybe it is the challenge in China. Ed, thank you very much. Ed Ludlow, keeping it real with the interviews on the West Coast. Let's stick with big tech. Amazon posts better than expected fourth quarter numbers. The drive, e-commerce, continued growth in the advertising. Abigail Doolittle is with me to take me through the numbers. I'm a big fan of Amazon.
Well, I'm guessing maybe then you were a part of those blowout holiday sales numbers, the best since the pandemic, really, on a quarterly basis. And overall, they did put up a sales beat, as you mentioned. Operating income, or adjusted earnings, I should say, a slight miss, but the blowout for sales overall beating up 14% year over year, about $169 billion. And again, driven by that strong holiday season for e-commerce. In addition, the cloud stabilized. Analysts are also highlighting margin improvement as a bright spot. And in terms of the outlook, the net income outlook is stronger than expected. Cost cutting really taking hold. Of course, they were one of the big tech companies last year to cut jobs, more than 35,000. Now, when I dig in a little bit, Manus, valuation looks a little bit pricey, 33 times forward earnings on about 13% sales growth. But today we have the stock up 6.1%, the best day of the year since October of last year. And right now we're almost a double off of the lows from 2022. So investors liking what they saw out of Amazon.
Okay, Abby, thank you very much. Whole paycheck, Whole Foods. Meta shares are jumping on earnings. Actually, it's very good value at Whole Foods, just to reframe. Then it's a $50 billion buyback, of course, at Meta. And it's the first ever quarterly dividend. Katie Greifeld is with me. Hurrah, how to allay the bears.
The year of efficiency is barreling on here, Manus. Fourth quarter results, they were strong. Of course, we're talking about sales gaining 25%, profits tripling, but it almost feels like those are just details in this report, because the focus is on that $50 billion buyback that you just talked about. That is the biggest announced buyback since 2021. And like you said, Meta unveiling its first ever quarterly dividend of 50 cents a share. That is good news for shareholders. Good news, too, for Mark Zuckerberg, who owns a ton of Meta shares. But in any case, we also heard from Zuckerberg that he's developed an appreciation for a leaner company. Remember, along with Amazon, Meta has cut tens of thousands of jobs over the past couple of years. And even as Zuckerberg really looks ahead to some of his big ambitions, the CEO said that he'd like to keep new hires, quote, relatively minimal to stay lean. And you can see that shareholders are psyched. Meta currently up over 16%, already at an all-time high today.
Yep, and it's certainly keeping a handle on the OPEX and the CAPEX as well. Katie, thank you very much for the very latest there. And finally, a solid set of results on the energy sector. Exxon and Chevron topping the earnings forecast, with shale drilling fueling that stronger output. Simone Foxman has the details. Simone, what have we got?
Yeah, Manus, the challenge for both of these companies this morning was to show shareholders that they can continue to return capital despite a falling price of oil, especially in the fourth quarter, and despite the fact that both shares have seen declines over the past year. And they did it by beating estimates pretty handily. Adjusted EPS for Exxon coming in at $2.48. The expectation had been for $2.22. Chevron coming in at $3.45 on a per share basis. The estimate had been for $3.22. Already, these companies were both among the top 10 payers of combined dividends and buybacks for companies across the S&P 500 over the past 12 months. This morning, we got word from Chevron that it would boost its dividend by 12 cents. Exxon, for its part, saying that it would resume buybacks of its shares after it completed the acquisition of Pioneer Natural Resources, says this morning that that is expected by the middle of the year. Both companies also talking about ramping up production production from the Permian pretty dramatically. Chevron by 10% over this year, Exxon by 7%, but note that it's going to double, overall double its output when it does complete that acquisition of Pioneer. And Exxon's trading unit delivering $1 billion in gains, offsetting some of its loss from the declines in oil. So are investors convinced? The initial reaction appears to be yes, though again, coming off a pretty terrible last 12 months.
Okay, Simone, thank you very much. My guests this morning are Victoria Fernandez and Michael Collins. You know, by nature, I'm a skeptic. By nature, I'm conservative on risk. But even I've got to throw in the towel and sort of say, look, overnight, I think this has changed. It's actually managed to shift a gear in my thinking on risk. Victoria, when you look through the emotion and you look at the reality of the earnings season, should I be as excited?
I still think that I would be a little cautious, Manus, and we are actually at Crossmark, and when we look at the total environment that we're in, you can't just look at a couple elements. You can't just look at a few tech earnings and say, great, it's risk on, because then you have this, risk of inflating some kind of a speculative bubble that may be going on with the Fed on hold right now. So I think you have to take a broader look. Look at leading economic indicators that have been down, 21, 22 months in a row. You look at the net profit margins that you're seeing, and they are the lowest. The blended net profit margins this quarter are the lowest they've been in 3 years. You look at layoffs. We're seeing a ton of layoff announcements out of the S&P 1500. Those companies that have announced were more than double the amount of companies that are talking about layoffs or have already enacted layoffs versus a typical bull market. And even the small business survey, it's the lowest amount of companies intending to hire that we've seen in 3 years. So I think there's a lot of concerns out there. Margins are a big concern that we talked about a little bit earlier, but that's not to say that there's not things buoying this market. Obviously, consumer confidence is doing well. Consumer continues to spend. Amazon is a perfect example of that. Yeah. And that soft landing scenario that many people think as their base case is helping support this market. So I think it's a somewhat balanced market right now. I wouldn't be overly excited. I want to be in the market, but I want to be cautious with the names that I'm investing in, making sure it's companies with quality earnings, solid balance sheets, good cash flows.
Michael, can I take it back to you? I mean, it's fine to be bullish on equities and your job and your wages. This is not going to make for comfortable reading at the Fed, is it? I mean, a hot wage spike, a jump in jobs. I know it's the dual mandate in full employment and inflation coming back towards base, and that fundamentally is happening. But this is going to perhaps, again, unseat the Fed and really push them to extend later and perhaps less.
Yeah, absolutely. And Manus, bond investors are born to manage downside tail risk, right? You think about our asset class, and the best case scenario is you get your money back and you clip a coupon while you're waiting. And the worst case is you get wiped out in a bankruptcy, right? So that's the nature of our business. And the Fed, is looking at this from a risk management perspective as well, right? And they're really focused on the inflation risk kind of reemerging on the upside, growth reemerging on the upside. And there is that upside tail risk out there. I think it's really small. And then the downside tail risk is that they wait too long, right? And the economy starts to unravel. I mean, to Victoria's point, even in the jobs numbers,
were you surprised by what Victoria just gave us there? I was actually quite surprised by Victoria's stats in terms of, at this stage in the reporting season, the scale of job losses. It's incremental each day, but it's like death by 1,000 cuts, isn't it?
Yeah, we're at the early stages, Manus, of a weakening, a softening in the job market. I mean, today's number notwithstanding, I mean, that could be a blip, when we look back on it retroactively. The markets, frankly, are taking it with a grain of salt. I mean, notwithstanding the big increase in front-end yields, you look at, 2-year yields, they're back to where they were, a few days ago, right? And equities aren't moving, credit spreads aren't moving. So the markets are really thinking, hey, this is a solid economy. It's slowing gradually. It's really about the Fed's reaction function, not over the next few months, but over the next, few years. And I think they're going to wait and wait and sit on their hands. That's what they do, and not cut until they really have to. So the aggressive market pricing in of a lot of cuts this year are starting to come out. Even today's big move in yields, we've only taken out 25 basis points of cuts over the next 2 years, right? So again, the markets are not that worried about this number, not really changing too much. But I worry that the Fed is going to kind of just not move and wait until something really unravels in the job market, and then not cut 25 basis points, but cut, hundreds of basis points pretty quickly. That's the downside risk that we worry about every day.
Yeah, I mean, at this juncture, one could say maybe that is a tail risk rather than a bell, rather than the center of the bell. Victoria, we've had big oil, big tech. We've had a number of real solid indicators here in the U.S. When you go for breadth beyond big tech in this reporting season, where are you most inspired by?
Yeah, so I mentioned a little bit earlier that we were looking both at financials and at healthcare. And I think these are areas that are showing a little bit of relative leadership versus the S&P 500 as a whole. There are names or sectors, rather, that we have liked for the last few months. And we think you have an opportunity to get in on some of these names. Pull back some of the allocation that you have in that big tech, and you can put it to work in these places, or use some of the cash that you have on the sidelines, right? We are hearing, you look at Deutsche Bank, they said it was the largest positioning in equities this past week that they've seen in the last 6 months. So people are getting into the market. You just don't want to jump on a bandwagon that maybe has gone most of its journey. So we like the big banks. We talked about balance sheets and cash flows. They're sitting in really solid positions. We like healthcare as well because it gives you a little bit of a defensive play in a market where we are a little bit concerned. And so you can have some of those opportunities in those two sectors.
Okay, well, let's keep an eye on those regional banks and the commercial real estate. Idiosyncratic risk, I understand, from everybody that's been with me this week. Let's just hope it stays idiosyncratic. Victoria, thank you very much, Victoria Fernandez. Michael Collins, my guest on the markets. Coming up, Donald Trump, he throws a bit of shade at Chairman Powell. What could that be? We'll discuss on Bloomberg.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
I know one of the reasons you're here in Marrakesh and in Africa because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal, and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times, those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
To the economy for a second. Would you reappoint Jay Powell?
No, I wouldn't do that.
You wouldn't reappoint him?
No.
Because he missed inflation?
He did miss, but no, I wouldn't be inclined.
Who's your choice for Fed chairman?
I would have a couple of choices. I can't tell you now.
That was President Trump speaking on Fox Business this morning. Joining me now with more on the jobs report, it is Bloomberg's Anne-Marie Horden. Anne-Marie, before we dig into the jobs report and politically, we're waiting to see what POTUS has to say about that. It's a difficult day for him, juxtaposed with other events that he's dealing with. But that interview with Maria Bartiromo this morning, it's interesting, isn't it, in terms of you wouldn't reappoint Powell?
Well, we've heard this before from the former president, Donald Trump, and he said, I think he's going to do something to help the Democrats if he lowers interest rates. So already you see the former president making this timeline that the financial markets are having, this debate about the timeline of when the Fed is actually going to go and cut rates. The former president is already starting to politicize it, saying, well, I think that Jay Powell might do this, and it is going to help the Democrats. And that's his latest reasoning. We should note his latest reasoning for not wanting to appoint him. He said in the past that he thinks that Jay Powell has been behind or delayed on some decisions. But also when Trump was president, even though he appointed Jay Powell, you have to remember those tweets he used to send off to Jay Powell. One of them, distinctively, I remember, he said he didn't know who was worse for the U.S. economy, Jay Powell or China's President Xi Jinping.
Wow, I mean, that takes you back. I mean, it was Twitter in the middle of the night. I remember I was living in the Middle East, and literally we got the tweets way ahead when you were all asleep. Look, here we are. We have the jobs report, which is going to be good news for the administration. Wages are hot. Jobs are plentiful. How do they communicate that? Because one of the criticisms has been the inability to articulate significant economic wins.
Absolutely. You've seen that in poll after poll. Our latest poll shows that in swing states, these critical voters say that they trust the former president, Donald Trump, when it comes to the economy. So the administration has a really good story to tell this morning. This is a blowout jobs report, and we're waiting for the president, who usually comes out with a statement. And Manus, I can guarantee you one line he's going to use. For 2 years straight, marking today, the unemployment rate has been at 4% or lower. That is pretty astonishing given the fact where we were in the depths of COVID.
When does this politically turn into a tailwind? You and I talked about the swing states. We've done it. We've covered it on Bloomberg, the Morning Consult poll. They trust Trump on so many other issues, and the economy is where they trust him more.
Potentially, we're starting to see that shift a little bit in sentiment. We saw that in the Michigan survey. We also saw that in the Conference Board. People are starting to feel better about the economy. But as they're starting to feel better about the economy, another important issue that's becoming front and center for them is immigration. And in our poll, when you ask 65 and older, their two most important issues, it's neck and neck, the economy and immigration.
Okay, well, we'll see what the status of POTUS's response a little bit later on. Anne-Marie Horden tracking the very latest on the political implications from the jobs report. Sector price action to be had. Abby is with me side by side. I know it's the juxtaposition, Abby, isn't it, between Meta and Tesla. So take us through what's going on.
Well, it's also the juxtaposition between those sectors that do well with rates higher and those that do well with them lower, although it's interesting because tech is not following the normal playbook, because we, of course, have communication services up nearly 3% on that blowout quarter from Meta and the outlook. Consumer discretionary being helped out by Amazon. We have tech up just about 3/4% 0.2%. So that is that juxtaposition with Apple dragging on that sector. But take a look at the bottom, Manus. Real estate, utilities, all down to more than 2%. Those are those dividend-rich stocks. They just don't look good when yields are up more than 10 bips. On the week, it's a similar story. Consumer discretionary is the best sector on the week, up 2.6%. We also have staples higher. So those are sort of uneasy bedfellows. And then on bottom, real estate dragging on that New York Community Bank Corp blowout, or blow up, I should say, and yields higher. And then energy also down 1%. And of course, right now, New York crude is down about 2%.
Yeah, that oil market is taking some of the heat out of the Exxon and the Chevron numbers. Abigail, thank you very much. This Friday, coming up in the show, the market moving events for the rest of the day. And of course, next week in your trading diary.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're
in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Very clear themes this morning in equities as yields spike, so real estate drags the Russell 2000 lower. Short end of the yield curve up by 15 basis points. There is a velocity to Meta and to Amazon in the NASDAQ. So you have still technology holding on to the green. Let me set you up with your trading diary for the rest of the day and the agenda. Starting on Monday, we're going to hear from the Atlanta Fed President Raphael Bostic. Tuesday, more Fed speak, Messer, Kashkari, Collins, and Harker. Plus, it is UBS earnings from Sergio Amotti and Ford. Thursday, the Treasury Secretary Janet Yellen testifies in front of the Senate. And Friday, we get the CPI revisions. Now, coming up on the show on Bloomberg TV, we're going to catch up with the acting U.S. Secretary, Labor Secretary, that's Julie Su, coming up at the top of the next hour. This is the moment for the administration to talk about the strength of the jobs market. This is going to be 24 months of unemployment sub 4%. That's it for the market. Open, squaring it away with higher yields and equity markets, which are trading up on the good news from technology, juxtaposed with that bid up in yields. A very good morning from New York.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Alex Steele, Paul Sweeney, we are live here. Looking forward. This is Jobs Day. Heck of a jobs number coming out there. Strong jobs numbers, strong wage growth. We're going to have the United States Acting Secretary of Labor, Julie Su, on in just a moment, and we'll bring that to you. Plus, Joni Biley, Chief Workforce Analyst at Employ Bridge. Get her thoughts on these markets. And then James Demert, Chief Investment Officer at Main Street Research, will get his market call. What's he think about this Fed March off the table? How about May for a rate cut? We'll have to see. Let's kick things off with Mr. John Tucker.
All right, we'll make this a quick one as we wait for the Labor Secretary. This report being brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads. Low, transparent commissions. Learn more at ibkr.com/bonds. Real quick data just popping up from the University of Michigan. The sentiment index, 79. The expectation, 78.9. One-year inflation expectations coming bang in right as expected at 2.9%. What's not to be confident about after the bang-up labor report? However, it seems to take March off the table for the Fed, so that has the Dow down 127 points right now. S&P 500 still higher after the earnings reports we got, 15 points higher right now. The NASDAQ 100, that is up 169 points. And after that data this morning, the two-year yield, 15 basis points higher, 436. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Happy Friday, Alex and Paul.
John Tucker,
Happy
thank
Friday.
you so much. Yeah, good stuff. Alex, how about that jobs number?
Unbelievable.
To the point, like, do we believe it?
Do we believe it?
Because it's just it's so strong. I mean, there's some cracks you can point to, right? Like if hours of work are a little less, how can pay be rising? So there are some stuff, but nonetheless, super solid.
Yeah, the upward revisions as well get your attention here. So just to kind of across the board, the total number of jobs plus the wages associated with those jobs, very, very strong. And fortunate we have the United States Acting Secretary of Labor, Julie Su, joining Bloomberg Television to kind of break down these numbers for us. Let's go to Anne-Marie Hordern. She has this discussion right now.
Bloomberg Television audience and radio listeners, I'm Anne-Marie Hordern. Joining us now, Julie Su, the acting U.S. Labor Secretary. Secretary, thank you so much for joining us. I mean, it was a stellar jobs report when you look through the numbers. Are you concerned at this moment, though, given what we have been seeing in the previous reports and today's surprise reading, that there is potentially an overheating in the labor market?
So this jobs report crushed expectations, as you've already noted. 353,000 jobs created last month. The unemployment rate remains under 4%. That's now 2 years straight. Labor force participation rate remains high, and we're seeing also, consumer confidence the highest it's been in some time now. The other thing to note is that wages are up, and for President Biden and for me, that's what we want to see, is more spending money in workers' pockets. So when you look at all of the numbers all together, it's not just that single one. This is really a sign of a strong economy that's continued to grow and continue to see broad-based growth.
Job market strong. You mentioned wages up. So how concerned are you, though, that that might still keep inflation in the higher realm and then potentially leaving Americans feeling unhappy about the state of the economy?
Yeah, so the president has said over and over again, right, one of his top priorities is to bring down prices. We've certainly seen inflation also, we're getting that under control. Things like gas and milk and eggs that cost more last year than they did this year. That is movement in the right direction. But again, if you look at the overall, not just this month's numbers, which are, again, beyond expectations, very, very positive, but also the trends over the last 2 years, it's a sign that President Biden's economic agenda, where we put workers first, where we invest in America, it is working.
But why are Americans feeling it? Poll after poll, it continues to show Americans are giving the president poor remarks when it comes to the economy. Our poll that was just released this week shows once again in 7 critical swing states, people say they have a better trust relationship about the economy with former President Donald Trump. How do you sell this message?
Well, it is, again, I think we're seeing those surveys move as well, and that is because people are starting to feel the change. A lot of the improvements, we came out of a global pandemic, right? A lot of those took some time to take hold, and I think 2024 is going to be a big year in terms of people not just feeling the benefits, but also seeing the historic investments under President Biden's leadership really hit communities, and shovels hitting the ground, and jobs continuing to come to communities to rebuild infrastructure, manufacturing, clean energy. So those are all central to the economic agenda of the Biden-Harris administration, and I think that the tide is clearly turning in terms of people feeling it. Now, that doesn't mean we're done with our work. We've got more work to do there, and we'll continue to keep our sleeves rolled up and continuing those efforts.
Well, is the administration, though, taking a recession off the table now?
I mean, people, said since I got here that everything was too hot. Things were going to crash. People talked about this elusive soft landing. I think the numbers that we have seen, again, not just this month, because we don't want to make too much of any one month, but certainly this month also. This is the very definition of a soft landing.
So you're not concerned about a recession?
I think, again, I'm not the economic expert here. I'm the labor secretary. What we focus on is making sure that there are good jobs in every community, and we connect people in an equitable way to those good jobs. But yeah, I think that the experts are saying that none of these numbers are consistent with a recession.
Okay, well, let's talk about some of the labor numbers then. The male 20 years and over labor force shrank in January. The male participation rate fell. The number of males employed fell. Female labor force grew. Female participation rate increased. The number of females employed rose. So all the strength is coming from women. Where are all these women coming from?
Yeah, I mean, I've said it several times, I think women have powered this economic recovery. And again, we saw women were devastated during the pandemic, right? It really exposed the challenges where we don't have adequate childcare, where we don't have sufficient paid leave policies. Those are things that the president has called for us to change. But we've certainly seen women come back to the labor market. The prime age labor force participation rate is higher than it was before the pandemic. And again, I think women are important to our economy. They're also really important for their families. And the jobs boom that we're seeing is helping, I think, to draw women into the labor market.
Do you see an issue, though, now, looking at these numbers across the board, with men in the labor force?
No, again, the overall labor force participation rate remained the same. For prime age workers, it ticked up a bit. We're also, we've been talking about creating jobs that do not require a 4-year degree, in order to rebuild roads and bridges and ensure clean drinking water flows out of every faucet. All of those things are creating jobs in construction. There's been investments in manufacturing. We're going to feel those more as the year progresses. And so, no, I'm not, the numbers don't give me any concern. And when I travel the country, I see people in training programs, in apprenticeship programs, hopeful about their future and feeling some more economic security.
With this jobs report, the Fed is most definitely going to be taking likely March off the table for a cut. So with expectations of the Fed cutting closer to the election in November, how concerned are you that this is going to become politicized?
Look, what we're concerned about is making sure that we're delivering for the American people every single day, making life better, connecting people to good jobs, putting training programs in place that are connected to the skills that are going to be needed, that are coming to communities. Certainly, we are in a political year, but the numbers don't lie, and we're going to keep on doing what we've been doing, which is focusing on job growth, focusing on equity and access to good jobs, and focusing on investing in America and America's working families.
I ask about it today because the former president was on Fox Business, and he said he won't reappoint Jay Powell if he were to win. And he also said that he doesn't like what he thinks Jay Powell is going to do, which is cut rates into an election year. But it's not just the Republicans. We also heard from Senator Sherrod Brown, Senator Elizabeth Warren, telling Jay Powell, the Fed chair, that he should be cutting rates. Is any of this helpful or appropriate?
I mean, I'm not going to speak for what other people are calling for. I will say that the president has said over and over again that we have to build an economy in this country from the middle out and the bottom up. That means starting with working people. That means leaving no one behind. I think that this jobs report demonstrates that that is working. We've seen wages increase. You're never going to hear me say that more money in workers' pockets is a bad thing. That's giving families more of what the president wants. He says we don't just do work for our income. We do it because it brings dignity, respect, and some breathing room. Those wage increases from this report are part of that breathing room.
Staying on message, Julie Su, thank you so much for your time today, Acting Labor Secretary.
All right, great. Anne Marie Hordern, with the Acting Labor Secretary, taking, I'm not going to call it a victory lap, but got to be very, very encouraged by the strong labor numbers I got out today in terms of keeping this economy growing.
Yeah, but I still think that the idea of people still feel bad and then the number's still good and bridging that gap and how that winds up playing out. We're still really early in 2024, but how that plays out, I think, really interesting.
Yeah, I guess that's a messaging story for, the politicians out there. You got a GDP print better than expected. Everybody kind of has a job. Wages are going up. Inflation's coming down. But, man.
But then you have to wonder, does that mean that we were going to wind up seeing the Fed not cut in May?
Yep.
And then does that keep conditions tighter? And then you have real rates actually increasing, et cetera, and then it actually does wind up hurting later. Sort of the longer you push it off, then are we headed for something a lot harder?
Yeah, that's a great point. And that's kind of the discussion now. I guess it's all about May. Joni Biley joins us. She's the Chief Workforce Analyst at EmployBridge. Joins us on Zoom from Pompano Beach, Florida. What is it? What are we doing wrong here?
I don't want to be in Florida.
I'd like to be in Florida right now because we haven't seen the sun in like 2 weeks.
That's true. I don't know. I was in Florence, so I mean.
Oh, there we go, John.
If we're reassigning, I'll
take
Italy.
The
you can
Tuscan
take Florida.
sun.
It's
under
true.
the Tuscan sun.
It's real pretty.
Joni, thanks so much for joining us here. I'd love to get your thoughts here and kind of what we saw on this jobs data print this morning. How do you kind of deal with it?
Well, definitely a big surprise, right? This morning, I don't think anyone predicted numbers that would be that high. I think maybe Goldman Sachs said it was going to be about 250,000, but never expected over 350,000 jobs created. And the reason I think it really is a surprise is we are still, seeing layoffs, not just in the big tech companies, but we're seeing more and more employers that are, cutting back. Now, there is some optimism about 2024. Certainly the companies that we work with at EmployBridge, I would say our hiring managers are cautiously optimistic, and they are saying that they are predicting, a better year of growth, of job growth in 2024 than 2023. But we're not seeing the robust growth that this report actually shows.
Well, let's talk about the one thing that confused me the most in the report, and that's average hourly work week goes down, which basically means maybe there's a demand problem, but wages go up. What does that mean?
Yeah, I was surprised by that number as well. So we are seeing people working a little bit less. The hours, worked per week did decline. And to your point, seeing wages go up so substantially, that was a surprise as well. We're not seeing as much wage movement. We track wage data as well. EmployBridge focuses primarily on the supply chain sector, so manufacturing, construction, drivers, transportation. And I will tell you, wages have been pretty flat. But when we see hours go down, it is the demand. The employers are not demanding, right, that workers are working overtime or, working really that full 40-hour work week. We're not near that level. So it definitely is a supply and demand issue. And again, I think something that would be concerning in this report. But there were some real bright spots in the report. Seeing professional and business services add, I believe it was 74,000 jobs. That was a big number. And we had seen some declines in that sector. I did go back and look at the revisions, and they have revised them upwards. So, those are more of the white collar professional jobs. And that definitely came back stronger than I think anyone predicted. We did see that also increase in the JOLTS report, the job opening report that came out earlier in the week. There was a big increase in the professional service sector job postings. So that is a good sign. That can mean some good things for 2024, that employers are, hiring more of those skilled positions.
Where are these people working, Joni? Are they coming back to the office, or is it 3 days a week, 4 days a week? I mean, we're like the last people to ask because we're in 5 days a week. So, but we're the normal people. What are they doing?
Yeah, so it is interesting. I think, one of the big concerns out there certainly is commercial real estate, because you can see in large cities that people are not coming back to work. They're not in the office buildings. Employers, and this again, mostly in the white collar, professional service jobs, and also in healthcare, we do see that there's opportunities to even work, remote or go to a hybrid schedule. And employees don't necessarily want to go back to the office. They like the flexibility. And I do have some concerns about that. I think there are a lot of benefits, right, of collaboration and working together and the social aspect. I have some big concerns about our younger generations that are just getting into the workplace. I have 2 children in college. I don't want them to have their first job and be working from home. They're going to miss out on so many great experiences and building those professional, communication skills. So I do have some concerns about it, but right now, for the most part, we're seeing hybrid models, remote work. Of course, that's very different in the trades and in supply chain where people really have to be on site.
Yeah. Hey, Joni, thanks a lot. We really appreciate it. It's really fun to dissect all of this with you. Thank you so much for joining us, Joanne Bailey, Chief Workforce Analyst at EmployBridge on that January jobs report, just coming in a lot better than estimated. I mean, it's true, right? Like, not coming into the office, we wouldn't have this moment between us. I couldn't bring you cookies.
No,
it wouldn't
exactly.
be the same.
It's not the same, but it's where we are. I think it's a new normal. I don't, maybe something that may change a little bit is if you do really go into a serious recession, jobs become, the market kind of loosens up a little bit, and maybe that'll give a little bit more leverage. But I just think most companies have adjusted as as well.
It's like, how do you say yes and then say no?
Yeah.
Like, you can work from home, no, you can't. Like, that's a tricky line to draw.
Yeah, so, I just think of my 27-year-old twins, it's just in their DNA. They can't even conceive of 5 days in the office, and they're pretty well engaged there. Well, more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The major stock averages, right now they're mixed. In the driver's seat, the idea the Fed won't cut rates in March after that hot labor markets report, the jobs report this morning. Sarah House, economist with Wells Fargo, reacted to the employment report a little earlier.
So, I mean, I think overall the message is this is a job market that is still incredibly strong despite all the efforts for the Fed to cool the economy.
Well, that has yields surging right now as we look at the 2-year. That is up almost 17 basis points. That's a big pop. That's at 437 right now. And then you still have earnings. Meta Platforms, Amazon delivering better than expected results, sending their stock prices soaring. Right now, you have 7 of the 11 major industry groups in the S&P 500 lower. Real estate, the biggest drag. Communication services, the biggest lift. And that's where you find shares of Meta 20% higher right now. Amazon, after its results, those shares up just about 6.5%. Overall, S&P 500, 18 points higher. That's up 0.4%. 49.24 on the index. The Dow Jones Industrial Average, 103 points lower. That's down 0.3%. The NASDAQ 100 right now is up 169 points. That is a rise of 1%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, Paul. Nope, you're John.
Doesn't
Yeah,
matter.
they're both sitting next to me. It's kind of the same.
Interchangeable.
I mean, no, I feel strongly about both of you. Okay, I'm taking a look at the markets here,
Sure you do.
and I'm a little bit confused. The Nasdaq is up 0.8%. Okay, that makes sense because you had big tech earnings doing really well. But the S&P is also up by 0.4%. On the flip side, the Russell down over 1% as yields pop higher. There's a couple competing narratives, right? Big tech still strong. High yields, maybe that hurts equities. Maybe you wind up having a Fed that's going to push out its rate cuts. That's going to be negative for equities, but the economy's strong. That should be good for equities. Do you guys get all that?
Yeah.
You got that? We're good to go now. Well, let's ask someone who knows more than us. James Demmert. He is Chief Investment Officer at Main Street Research. Hey, James, there's a lot of conflicting narratives here. What's the right one for you?
Good morning, Alex and Paul. I think the narrative is, you know, again, investors get really caught up with Fed talk and you know, you just look at the basic fundamentals here. We had a blowout jobs report. What does that tell us? Investors should know the economy is really resilient, right? I mean, that's really great data there this morning. And then I think at the same time, you know, there's a concern that people are sort of caught up with the Fed has to keep cutting rates or has to start right away. And they're doing the right thing. I mean, they're lucky or smart that they've got the economy right where they want it. Who would have guessed? And so I think investors here should realize inflation's gone. The PCE, their favorite number, right? Less than 3, very close to where they want it to be. They don't need to cut, and you've got a resilient economy. What that means? New business cycle, new bull market. Keep it simple, investors. Don't overthink this. Earnings are what drives stocks in phase 1. That's where we are. Focus on earnings. Look at Meta, right? Look at Amazon. Look at Microsoft. Focus on earnings. Yes, higher rates can have an effect, negative effect on certain parts of the market if rates are higher for longer. We can talk more about that.
Yeah, I mean, I'm a former equity analyst, so I like to think earnings matter. I spent so much time trying to figure out where the earnings are going for some of these companies, build these monster models. What are you seeing so far, James? Again, today is all about the Fed, but again, we've had a ton of earnings, including some big tech last night. What do you see in some of the earnings that we've had so far?
Well, I think, you know, one of the things investors should really focus on here is, you know, what's driving these earnings. And one of the things I think that all of us should be excited about, you're already seeing it in tech earnings, is this effect of AI, right? That's going to be a tailwind for better productivity growth within companies. That should lead to higher stock prices over time. We're also, and I think this is really important, the Meta numbers show us that as an equity analyst, you can appreciate this. We've gone through an era of efficiency, what we call it, otherwise known as cost cutting. And that cost cutting that a lot of companies have done over the last 18 months as they had inflation fears and market fears is now coming to be very rewarding. So I think, you know, the cost cutting is obviously increasing margins. Meta, a really good example, but this going on across all sectors. And then you've got this sort of forward-looking productivity growth that we're really excited about. And that's why we think not just a new business cycle, but maybe a super cycle.
Ooh, a super cycle, a business super cycle. But hey, if we wind up having higher for longer now, But the economy actually is heating up and it's just kind of firing on all cylinders. Doesn't that at some point, isn't that bad for equities?
Well, it could be, and it could be bad for the economy, and it could, bring the inflation boogeyman back. And that's why, again, investors should just get over their anticipation the Fed has to cut. I think the Fed's doing the right thing. They see this economy is strong. The last thing they want to do is cut. I think that's exactly where we'd end up, in that risk of, oh gosh, now it's, they've really juiced it by lowering rates when it was already pretty smoking hot. I think if the Fed sort of just sits back and does nothing, and let's face it, it might be that, everybody anticipates all these rate cuts, even the Fed does this year. It could be the economy is strong enough that they don't need to do any, and earnings then will drive stocks. So I think as long as the Fed keeps their hand on the tiller very carefully here, the economy can grow all by itself. The market is obviously pushing interest rates up today. Let the market do that. Keep the Fed out of the way, and I think the economy can be perfectly fine and not overheat.
James, I like big numbers as much as the next person, big round numbers, and you've got them in your research. You say over the next 10 years, the Dow Jones Industrials could cross 100,000, S&P 15,000, NASDAQ 50,000, all within the next 10 years or so. What's kind of the thesis that gets you those kind of numbers?
Yeah, Dow 100K, right?
Yep.
Some historic reference. I just finished my recent book, which is really about the market and what it does over time. And so, really what we're using is some data points. One is, if it is a new business cycle, which we believe it is, and if it's an AI-driven productivity growth type of cycle, what we're doing is we're attaching what would growth rates be for companies, and we can see earnings tripling over that 7 to 10 year period. That's usually as long as a business cycle lasts. 10 is a long time. I'd say 7 to 8, 9 years. We'll probably see earnings triple again with this AI tailwind. And that's sort of, you just do the math, right? The Dow goes to 100 grand. The S&P goes to 15. And the NASDAQ and the S&P probably, we'd say NASDAQ is 50,000 because that's the core of where that AI really is going to provide better earnings growth.
Whoa, that feels like a lot. What's your downside to that thesis? Like, what would be your risk to that?
Well, that's a good point. I mean, you can't just say, well, that's going to happen and let's put it all in index fund and go home or come back in 10 years. I think there's a lot of risks in this. And one of them is, a lot of them are the obvious ones, right? If we fall into a significant recession, maybe because the Fed doesn't manage the interest rate cycle correctly, I think I'd give them the faith that that's not going to happen. But we also have, we have national debt that's a problem. Usually that's taken care of as it was in the 90s. We had such a big economy, we actually filled the debt back, that hole that the debt was creating. We filled it up by capital gains taxes on corporations. But you've got some stuff going on. And of course, we have this geopolitical risk. They can always turn the world upside down, which is why, in our case, we use risk management tools. I think it's very important, investors, things like stop loss orders are really important. Know how much equity exposure you need. Even if I say Dow 100K, I'm not saying investors, you should be fully 100% in stocks. Understand your planning, how much risk you need to take, and only have enough equity exposure to get the return that you need, because there are those risks out there, and there's some ways to protect yourself.
What are some of the sectors that you think are interesting right here, James? A lot of folks, we got a lot of tech numbers over the last couple of days showing some pretty good strength there. What are some of the sectors you guys like?
Yeah,
aside from tech.
I know, right? It's the elephant in the room. We are big fans of tech, and that's where we're overweighted. But gosh, if you look at just about every other sector of the market, and this is important, if you look at forward PE earnings, PEs, right? Usually PEs are not correct when you're starting a new business cycle because the E is going to be bigger than people expect because of the earnings and the profit margins. So we look at valuation and we look at what sectors look good. Oh, it's not just tech. It's the financials. They're historically cheap. It is the industrial companies, historically cheap. A lot of this stuff is less than 15 times earnings. I think even, if you wanted to reach out into the REIT market, which has gotten crushed, or the small cap stocks, which are not acting well today, but they certainly would thrive over the next few years, I think investors should look there. So I think pretty much broadly across all sectors, you're going to see some better earnings from these low valuations. And again, you're going to have the AI tailwind. I mean, AI is going to have a tremendous effect on healthcare. And we're really excited about that as well. Low valuations in that sector.
All right, James, thanks a lot. That was a bullish view to a Friday. We appreciate it. James Demert, he's Chief Investment Officer at Main Street Research. How's that? 50,000 for the NASDAQ. There you go.
Yeah. What was the S&P? I'm trying to, I got my calculator.
51?
Now look at the S&P.
No, 15,000.
15,000.
100,000 for the Dow.
Wow.
Nice round numbers.
We're good?
Power of compounding. Yeah, your 401k, we're going to be looking
10
good
years.
there.
10 years, and then we can all retire.
That's why I tell my kids the power of compounding.
Paul and I are not going to be here. I mean,
let's be honest.
And I'm not talking Bloomberg. I'm talking Earth.
Come on. Oh, 10 years, please.
Yeah,
John
10 years
Tucker.
is nothing.
He's a spry 40.
Exactly.
All right, let's get now to Amy Morris for world and national news. Amy.
All right, thank you, Alex. The Senate is gearing up to vote on a deal to secure the southern border and provide new military aid for Ukraine. Senate Majority Leader Chuck Schumer says lawmakers are close to reaching a deal, and the first vote is coming next week.
As for the timing of the vote, I plan to file cloture on the motion to proceed to the vehicle on Monday, leading to the first vote on the National Security Supplemental no later than Wednesday.
The bill will include border policy changes to stop the flow of migrants coming across the U.S.-Mexico border and funding for Ukraine, Israel, and Taiwan. The vote comes after months of intensive negotiations between a bipartisan group of senators and the White House. But the path of the deal is uncertain in the House, as Speaker Johnson has claimed it does not go far enough in restricting migrants from entering the country. Former President Trump says he would not appoint Jerome Powell to head the Federal Reserve if he is reelected in November. We talked with Bloomberg government reporter Zach Cohen, who tells us Trump has pretty much always been critical of Powell.
Former President Donald Trump has obviously been a rather regular critic of Fed Chairman Jerome Powell over the years, including back when Powell was chairman of the Federal Reserve when Trump himself was president. And so this is not an unusual situation for the Fed. But Trump went a little further today and actually said that he would not appoint Powell to head the Federal Reserve again when his term expires in 2026.
Trump says he's concerned the Fed is trying to lower interest rates just in time for the election. Bloomberg government Congress reporter Zach Cohen tells us there is more concern now about the appearance of political interference and maintaining central bank independence. And don't forget, Fed Chair Jay Powell is scheduled to be on 60 Minutes this Sunday night at 10 Wall Street time on Bloomberg Radio in Washington, D.C. And global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
I'm John Tucker at the Bloomberg Newsroom. This Bloomberg. I don't remember being on camera before, so it's like I fixed my glasses anyway.
Welcome to my world.
Yeah, a couple of things in the driver's seat: data and earnings. Employers adding the most workers in a year. Wages jumping. All a surprise reacceleration in the labor market, and then you have better than expected earnings from both Amazon and Facebook parent Meta. They are the number 1 and 2 leaders right now in the S&P 500. Apple did report a deepening slump in China during the holiday quarter, and analyst Gene Munster, he was on the program earlier this morning. He follows Apple at Deepwater Asset Management.
So if you think about what's going on at Apple, it really can be zeroed into the weakness in China. China's 20% of their business. And then the question comes to, what does China look like going forward? And I think the answer is to continue to expect it to be down.
And right now, shares of Apple down 1.2%. Meta shares 21% higher. And then you have Amazon shares. Those are up about 6.4%. Now, the idea of a March rate cut from the Fed increasingly off the table after that much stronger than expected jobs report this morning. The 2-year yield, that says it all. That is up 17 basis points, 437 on the 2-year. The 10-year is up 14 basis points, back above 4%, 4.02%. S&P 500, 23 points higher, up 0.5%, 49.30 on the index. The Dow, 68 points lower. The Nasdaq 100 up 188 points. That's a rise of 1%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here with you on our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio, and that's where you will find us. Again, as John was just reporting, a couple of the stalwart tech names reporting last night. Amazon, good quarter, stock up 6.5%. It's up very close, within a couple of dollars of its all-time high, and it is a 52-week high, but just a couple of bucks away from its all-time high. Meta also reported numbers. Stock's up 20%. This is $1 trillion market cap stock. It's not like a penny stock. This is $1 trillion market cap stock. No, and it's up 20%. So some real paper money's being made out there for some people. Let's break this stuff down. We can do it with two of our best at Bloomberg Intelligence. Poonam Goyal, she covers the retail business for Bloomberg Intelligence, and Mandeep Singh, supposedly a tech analyst. We'll see if he's got the goods here today. Poonam, let's start with you. Amazon, it seems like the consumer's in pretty good shape. What'd you hear from Amazon last night?
Yeah, thanks, Paul. The consumer is in excellent shape, and that's part of the strength that we saw in holiday. So the 9% online sales gain that you saw come from them and 20% in third party was pretty impressive, and actually probably the best in a few years since after the pandemic. So clearly a sign that the consumer has the funds to spend, but I'd say it also means that the consumer is choosing Amazon to spend their funds there. I think that's very key, as you will see some losers still coming out of the holiday season, but online is gaining traction. Yep. And Amazon is what comes to mind when you want to shop online.
Sure. So what I found to be really fascinating, it was like a nugget, I forgot what research report I read it in, but that the cost to serve a customer's order fell by 45 cents a unit last year. How big a deal is that, and how hard was it to get there?
So Amazon doesn't disclose how many units they sell, so it's kind of hard to back into that. I'd say it's still a fairly small piece of the cost base, but what I would say is what's going to help them to continue to drive these costs down is just the efficiencies that they've created within their fulfillment network, right? You've heard them talk about getting packages to customers faster, and that's really a function of how they centralized their shipping and distribution networks, and we think that traditionally, when you hear about things coming to you faster, it's usually more expensive. And in the case of Amazon, it's actually cheaper. So it's pretty impressive, and it's all driven by scale.
The trucks are everywhere. I mean, it's just amazing. They got to be the biggest trucking fleet in the country. I don't know. All right, let's bring in Mandeep Singh here. Let's get to the technology aspect of Amazon, which has really been the driver of its profitability, and many would argue the stock price performance. Mandeep, what did you hear from Amazon last night about its cloud business, AWS?
I mean, look, I think when you compare it to Microsoft Azure growth, the growth is still kind of far weaker between the two. But Amazon is, much higher run rate, a $97 billion run rate. So they clearly seems to be stepping up in terms of their generative AI exposure, and they've given investors hope that they will be able to catch up. But look, overall, I think profitability-wise, they seem to be doing very well on the AWS front. Ad business continues to work very well for them, 26% growth. So Amazon, I think the diversification play they have and the fact that they seem to capitalize on any new trend, seemingly fast, even though in this case, Microsoft Azure clearly still has the strongest momentum when it comes to generative AI.
What I also found really interesting, Mandeep, is that with Amazon and even Meta, they're spending more, but the market feels okay about that. I saw the same thing with Exxon too. They're spending a little bit more, but their market's okay with that. What do you make of that?
I mean, look, when Meta is growing at over 20%, nobody cares about the Reality Lab losses. So even if they're losing $18 billion a year on Reality Labs, it's okay. They get a pass. The moment that growth tapers, and we saw that in 2022 when they had those negative quarters, everyone, started to complain about, how irresponsible management was in betting on metaverse. And yesterday, there was not even a mention of Reality Labs, given, the beat and raise and the fact that they really seem to be executing very well with 25% layoffs. So it all comes down to your top line. And if they keep executing the way they did last quarter, I think people don't mind the CapEx. And generative AI CapEx actually is a trend that we are seeing across the board from hyperscalers. So what we heard last night was Meta does have a generative AI play. It may not be on the cloud, but they are deploying their AI assistants everywhere, and that seems to be helping engagement.
Hey, Poonam, give us this update on the advertising business for Amazon, because I think that's a business not enough people pay attention to or gets enough credit, because there's some big numbers there.
It is. It's actually at a run rate of 60 billion now, and we think it can get to 100 billion by 2028. So clearly great growth there. And what you have to remember, and Mandeep mentioned this a little, the advertising business is very lucrative. It carries about 50% profit margins. So if you think about just the run rate they're at, that's $30 billion to the bottom line in the coming year. That's huge for Amazon. And that's really the backbone of what's driving profitable growth in North America, or you could say their retail business.
See, that was revenue that propelled my career, is that advertising revenue. But during the peak of my career, it was radio, TV, cable TV, maybe even a little bit on newspapers.
We still love the radio, people. We love the radio. Exactly. We're sticking to the radio.
Now it's $60 billion going on Amazon.
Amazing.
Wow.
Hey, Mandeep, before we let you guys go, to your point before, if we keep getting these kind of numbers, can we still call Meta a growth company, even though it's now paying this dividend? Typically, you don't see that in the growthier companies. Can all things be true?
I mean, advertising is a very cyclical business. Right now, we are coming out of a trough, and ad pricing environment is improving. And if you are an e-commerce company, there is nowhere else to go to acquire customers, given Meta has 4 billion, users across its family of apps. So clearly, they get that mind share, and it's still a duopoly when it comes to digital ad spending. But I would say we are closer to saturation in terms of that digital ad growth than we were, a couple of years back. So not a lot of runway in terms of maintaining that 20% plus growth, but the next few quarters, I think they clearly will benefit from this ad pricing tailwind.
All right, guys, that's good.
Yeah, amazing. Guys, thanks a lot. Really appreciate it, Mandeep Singh and Poonam Goyal. Really great. I mean, I was shocked when I saw those numbers. Apple didn't surprise me that much, but when I saw those numbers come through the terminal yesterday on the close, I was just totally floored.
Now, the thing with Apple, and we've talked to a couple experts today, including Gene Munster, is if I were an investor in Apple, I'd still be really concerned about China. I don't feel like I don't have a call of, hey, is it just the Chinese economy kind of slowing down, or is it Chinese people saying, I'm not buying Western stuff. I'm buying, it's more nationalistic. Now, that's a concern. Although IDC, the research firm, says Apple's got its best market share ever. So I don't know how that's all playing out. So, but
competition is real. No matter which way you look at it, it's all about competition.
Yep. So, all right, we'll have more coming up. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with some of the stories we're following. The company stories. Fears of broader bank turmoil are overdone. The risks are already backed into the credit ratings and share prices of most lenders. At least this is according to the CEO of Axos Bank. You might know Axos Bank. They're the one that hold the mortgage on Trump Tower. So the CEO says this isn't really some big credit bank crisis that's coming down. Whatever's embedded in the stock price for credit for banks is well overblown for what I think it's going to be. A direct quote from the CEO, Greg Garrett-Brents. A blockbuster anti-obesity medication straining the budgets of state health plans and Medicaid programs. So this is a growing problem. Analysts and researchers say it requires more innovative payment models to ensure the drugs are accessible to patients. So you have North Carolina's state health plan voting to stop covering GLP-1 medications like Novo Nordisk's Wegovy and Ozempic, and also Eli Lilly's drug for its roughly 480,000 state employees. And an Israeli software startup, one of the world's biggest shipping lines among companies that for the first time are opening up commercial trade routes running through the heart of the Middle East via new land routes with trucks to bypass the Houthi-menaced Red Sea. And Tesla drivers no longer have to squint to read the warning lights in their electric vehicles, thanks to eagle-eyed auditors at the National Highway Safety and Traffic Administration. The regulator posted an unusual recall report on its website today from Tesla. The manufacturer acknowledges 2.2 million of its cars use too small a font to warn about braking issues. and they say they're releasing a software update to fix it.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. Alex Steele here with Paul Sweeney. You're listening to Bloomberg Intelligence. You can catch us on the radio. You can also catch us on YouTube. We're pretty much everywhere you want to be. All right, taking a look at the market here. We are still outperformed by tech. The NASDAQ up by over 1%. Let's get you right now to Amy Morris for world and national news.
All right, thank you, Alex. A convoy of protesters angry about the Biden administration's border policy has made it to Texas. Democratic State Senator Jose Menendez says people cross the border all the time legally to shop or dine out, and that's something he worries these out-of-state protesters might not know or understand.
They're going into what's already a volatile situation with high tensions between state officials and federal officials and a lot of innocent people in the middle.
The so-called God's Army from across the country planning a 2-week-long protest, raising awareness about the crisis at the border. President Biden will join families of 3 American soldiers killed overseas when their remains are returned to the U.S. today. 3 Army Reserve soldiers were killed in Jordan last weekend when they were attacked by an Iranian-made drone. A top U.S. senator is floating the idea of sanctions against Hungarian Prime Minister Viktor Orban. Bloomberg government Congress reporter Zach Cohen.
The latest call from Senator Ben Cardin, who's the Democratic chairman of the Senate Foreign Relations Committee, has said that Orban, who has been holding up this accession of NATO, said that he should be sanctioned.
Bloomberg government Zach Cohen tells us 2 other senators, Democrat Jeanne Shaheen and Republican Tom Tillis, are also criticizing Orban for slow-walking Sweden's NATO bid. Southwest Airlines is set to be the latest airline to carry Narcan on its flights. Michael Massoni is with Transport Workers Union Local 556, representing more than 21,000 Southwest flight attendants, and he says he was pivotal in getting the opioid overdose reversal drug on their planes.
I absolutely believe that in the current environment that we live in, that this will help save lives.
Legislation was introduced in May of last year requiring all airlines to carry the opioid overdose medication on board. It is set to go through the committee process. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul and Alex.
All right, Amy Morris, thank you so much. We appreciate that. We were just talking about this big 20% move in Meta, and I said, boy, I think a lot of people are making a lot of real paper profits today. Sure enough, Bloomberg News has got a great story. Meta's $200 billion surge is biggest in stock market history. $205.3 billion as of the posting of this story was just made in stock price appreciation today.
That's incredible.
Amazing.
And I was making the joke about it's not a biotech company, because that's what you normally see with a smaller biotech company. They have good results, they make one drug, and all of a sudden their stock is up 300%. This is like the equivalent of that for a Meta.
Yeah, I mean, it's a $1.2 trillion market cap company. I'm looking at Rich Go because it's aspirational for me. I'm not on the list working towards it. Mark Zuckerberg, he's on the list. He's number 5. This Rich Go rates the the wealthiest people in the world. He's number 5, 142.4 billion.
Does this update in real time, though?
I think it's a day lag. But
even more.
Yeah, so he's going to be up another, $30 billion today. That'll put him up probably number 4, maybe above Bill Gates, and so that's pretty interesting. But year to date, as of yesterday, he was up 14.3 billion. So he's having a good year.
Yeah, maybe it's because also Elon Musk is not.
A dividend.
Yeah.
And Bloomberg News had this story. I think his dividend income, I forget what the number was, but it's $750 million a year of dividend income.
Yeah, I mean, that's a steady stream there. But I have questions.
Yeah.
Now, for those of you who don't know me, I'm risk averse. Inside, I'm like a 95-year-old woman who wants to put soup cans and gold bars under her bed. And my question really is, they're still spending more. I appreciate the growth rate. I appreciate all that. But at what point do we still care about the losses that are happening in Reality Labs and the continued infrastructure spending? We seem to care about that with Microsoft. We seem to care about that when it came to Google. So why not?
The market really cared about it in 2022 when the stock was down huge, and they announced they were getting it, doing this metaverse thing. They changed their stock symbol. Then last year, it was the year of just cutting back.
Fair enough.
And the stock more than doubled on that news, and I guess that's still kind of the narrative. Yes, they're spending, but they're spending less than maybe they initially want, and that's the upside. Give Mr. Zuckerberg some play money. This is Bloomberg.
Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to talk to Joanne Shu, University of Michigan Surveys of Consumers Director. We had the UMich numbers came out today. I thought pretty good. So we'll go to the smart people out in Ann Arbor and get the latest. It's Friday, which means we talk municipal bonds, baby. Joe Mysak, rock and roll person, covers all things municipal bonds. He'll be in here to give us some thoughts on what's happening there. And then Brian Egger, he covers the gaming, the lodging space. He's got some interesting research about Super Bowl bets. We're going to get a lift, more markets, and they're going to help with the Super Bowl, but they're also going to get help with T-Swift. It's going to aid the sports books in Vegas. Why not? Right now, let's kick things off with Mr. John Tucker and a Bloomberg Business Flash.
Why not? This Business Flash being brought to you by Interactive Brokers. Interactive Brokers charges U.S. dollar margin loan rates from 5.83 to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. S&P 500 did pass Monday's closing levels, so that means we're on track for a record close if we keep up these levels. The two leading stocks in the S&P 500, you guessed it, Meta Platforms and Amazon.com. After their earnings report, you have Meta up 21%, Amazon 7.2% higher. In the meantime, today's way stronger than expected jobs report. That's going to change the Fed's thinking, according to Mona Mahajan at Edward Jones.
I think now people are looking towards May and June for the Fed to start its rate cutting cycle. We do still think that they will pivot from this pause to rate cuts later this year. But Jerome Powell told us on Wednesday he's willing to take his time. He doesn't want to see inflation pick up again. And in fact, this jobs report this morning may give him a bit of pause when he sees that 4.5% wage gain figure, average hourly earnings figure.
Well, it's given traders pause. The swap contracts referencing the March Fed meeting cut the odds of a quarter-point rate cut in half. Right now, it's about 15%. The S&P 500, 27 points higher. That's up 0.6%, 49.33. The Dow Jones Industrial Average, 55 points lower. The NASDAQ 100 right now, 181 points higher. That is up just over 1%. And the two-year yield, this is an eye-popper, 17 basis points higher, 437. The 10-year, the benchmark, 15 basis points higher. That's above 4.03%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
You would have told me we've seen a 17 basis point move on the 2-year, and I would have told you, woof, equities are definitely selling off, and that is 100% not the case.
Yes,
you strip
exactly.
out tech, maybe?
Yep.
I don't even know about that. Maybe the Russell's getting hit a little harder on that. So we brought up University of Michigan sentiment. So this is a wonderful indicator. The inflation expectations also can tend to move markets. We got the final read for January. Here's where they stacked up. University of Michigan sentiment up to 79. Current conditions lower than the last read, but at 81.9. Expectations much stronger actually at 77.1, and the 1-year inflation expectations at 2.9. We've kind of been around that level for a while. What we want to do is bring you direct analysis from the person who knows these numbers, who did these numbers. And for that, we're joined with Joanne Shu, University of Michigan Surveys of Consumer Director. She joins us now. Joanne, always good to see you on a UMich day. What's your take from the numbers?
This is telling us that consumers are really starting to feel more assured that the inflation slowdown is going to continue. They had been reserving judgment for much of the fall of 2023, not really sure if the slowdown was going to persist or if inflation was going to come back. And at this point, they're feeling much more confident about it. And that is the main thing that's supporting this very large increase in sentiment that's been continuing on for 2 months now.
So, Joanne, the good sentiment numbers that you're talking about, I guess coincide, or let me ask you, to what extent do they coincide with the fact that, again, we got the non-farm payroll number came in today really strong. Kind of everybody who wants a job, has a job, that figures into your data as well, right?
Oh, absolutely. Consumers are by and large they're workers, and so they recognize that labor markets are strong, and that's also bearing out when we ask people about where they think their incomes are going in the year ahead. Their income expectations have strengthened over the last few months, and that's very much supporting strong consumer spending as well as their strong levels of sentiment.
Joanne, is there any divide between if the respondents identify as Democrat or Republican?
So there is typically a partisan gap in sentiment, and this month is no different. As it turns out, this 2-month increase, Republicans saw most of that gain in December and were not particularly changed in January. Independents as well as Democrats, they also saw a gain in December and continued to gain in January as well. For all three political groups, we're at the highest level of sentiment in a couple of years now.
So,
interesting.
What is your sense? I mean, when your survey work, I mean, is a recession still kind of on the table? Or if you take your data, you take the GDP print, you take the labor print, I'm not sure I can make a recession call here.
Consumers actually are quite split on what they think is going to happen with the economy going forward. There's still 48% of people who are expecting challenging, bad times with business conditions ahead, compared with 41% who expect good times ahead. Now, this isn't to say that we will be in a recession. Consumer sentiment numbers are about 7% below average, so they're nowhere close to the lows we were seeing last year. But the fact that we're on an upward trajectory, we're pretty much back to the same upward trajectory that we've been seeing since the all-time historic low from June 2022, and that definitely bodes well in terms of supporting GDP growth in the months ahead.
Here's what I find confusing, Joanne, because if you wind up having respondents feeling better about the economy, which would imply like, okay, maybe the Fed's going to cut rates so I can feel a little bit of pressure ease, but then because of that, we see an acceleration, which then increases GDP, which then means the Fed has to keep rates higher for longer and not cut. Is any of that track in the data and the conversations that you have?
I mean, I think this is, you ask an interesting question. And the reason this is interesting is because, the survey is not happening in a vacuum. Policymakers, including Fed policymakers, are reacting to lots of data, including ours. And when we are asking consumers what they think is happening now, they are folding in their own expectations for where Fed policy is going to go. We have the largest share expecting rate cuts since 2008. So consumers are absolutely expecting rate cuts in the year ahead. Now, of course, if all the strong indicators in the economy lead the Fed to to exercise more caution in their rate cuts, I think we'll see that play out in consumer expectations, especially as it passes through to consumer interest rates and credit conditions. But in this very moment, consumers are expecting much more strength in the economy than they were expecting 6 months ago, a year ago.
All right, Joanne, it's good to catch up with you. We'll get you for that preliminary February read, too. Joanne Chu, University of Michigan Surveys of Consumers Director. Paul, do you feel better than you did a month ago?
I do. I think I feel like I can really see the end in sight for the Fed, and that's all I need. That's really all I need. And I think if earnings are going to kind of stay in there relative to where the market's discounting, I think the market's set up for a pretty good move here. And we've seen a lot of it. We've seen it. The question is, how much do we, see in November and December? This is a day of earnings as well, big tech earnings, and there's some themes coming across here in terms of AI, in terms of digital advertising that are pretty bullish, pretty constructive here. And we've been talking about it most of the morning here. We're going to bring in Angelo Zeno. He's a senior equity analyst and vice president of CFRA Research. He joins us via Zoom from New York. Angelo, I'd love to start with Apple, because for me, that's the most fascinating story coming out of big tech. I just don't know which way to go. And my big issue is China. Could you give us your sense about how you think China is as an opportunity and as a risk to the Apple story?
Yeah, and I think Apple, there's a huge bull-bear debate going on with that name right now. And when I think about Apple, yes, I mean, China is absolutely an issue right now. We're talking, a 13% decline in revenue in that region, when overall you actually did see, a broader industry growth in the December quarter there. mid-single-digit decline on the constant currency basis. From that perspective, doesn't seem as bad. My guess is some of the guidance that they alluded to, even though they kind of blamed some of the tough comps from a year ago, probably also indicates that there is going to continue to be some weakness going on in China, probably through calendar 2024 at the very least. So, China becomes an issue for Apple, becomes a headwind. We do expect them to continue to lose share, but there is so much good stuff going outside of China, where we think kind of the story really plays out. But specifically in Asia, Asia grew 7% outside of China. And, you kind of look at areas that are going to continue to attribute, to that installed base growth. It's going to be areas like India and Indonesia over the next decade plus.
So, Angelo, what's it going to take for Apple to get credit for that? Because it feels like the straight-up China competition is truly what this company is trading on.
Yeah, I mean, it's going to take time first. I mean, but, when we think about the actual numbers here in terms of, not the top line, but more on the bottom line side of things than on the free cash flow side of things. And that's really what drives, we think, the valuation is in Apple. It's that free cash flow number. Despite the $5 billion or so less in expected revenue, the free cash flow number hasn't budged in terms of expectations here over the next year. And a big reason for that is because of all the kind of improvement they're doing on the margin side of things, the better mix on the services, but also the fact that margins are improving not only on the services side, but also on the product side of things. So that's really kind of helping to sustain, the actual free cash flow potential of this company. So, you have to be patient if you're an investor in this name and kind of believe in the whole compounding effect over time. But right now, it's tough to really kind of expect significant gains from a stock price perspective here over the next 3 to 6 months.
All right, we'll talk about significant gains from a stock price perspective. Meta Platforms up 20% today, all-time high. Over $200 billion of market cap was created just today in trading. So, and they're paying a dividend. They've been listening to me. Now the folks at Apple need to listen to me and up their dividend and give me a good 3% dividend yield. Talk to us about Meta here. Boy, it seems like everything's working there. What's your key takeaway?
Yeah, I think this is as good a quarter as an investor could have asked for. I mean, you're right. They initiated the dividend, but it implies less than a 1% dividend yield, right? I think it's more kind of the fact that they're just demonstrating to investors out there the conviction they have in that business and kind of some of the guidance that they provided out there. But listen, I think they're running on all cylinders. Grew the top line 25%. Actually, Q1 guide points to an acceleration of growth where we actually expected growth to start to decelerate sharply in the first half of 2024. You kind of look at how they're doing this. They're actually keeping operating expenses in check. And there's nothing better that Wall Street likes than kind of keeping the OpEx numbers in check in a world where AI is extremely expensive. And they continue to grow that top line by holding, by keeping it unchanged. So I think, that's really the key as far as the Meta story is concerned. And you really do have to love it if you're an investor.
I mean, Paul does. He's been talking about it pretty much all day. But the idea that like the year of efficiency of 2023 will continue despite the information we got on Reality Labs in terms of how much they're losing and the CapEx going into it. When do I care about that when it comes to Meta?
As far as, losses in Reality Labs and the potential revenue trajectory there, this is a long-term vision for the company. So they're making these investments for 5-10 years out from now. You're not going to get the immediate type of return that you're seeing on the AI side of things. I mean, AI has been absolutely phenomenal for Meta because it's apparent that advertisers are willing to kind of pay up for it because you're getting a higher ROI out there. So, it makes a lot of sense. You're seeing most of the kind of the extra CapEx spend that's going into this company really on the AI side of things. But as far as those losses are concerned, that's gonna remain because you're not gonna see that revenue trajectory really kind of play out for at least kind of another 3 to 5 years at your, in the best case scenario.
So, Angelo, if investors are trafficking in the Metas of the world, the Googles, even Amazon, they have to have a call on digital advertising. What's your call on digital advertising?
So entering the year, it was it was a high single-digit growth rate. So, you know, it was pretty much going to be a similar growth rate that we saw in 2023. And our outlook for 2025 also kind of at a high single-digit growth pace. I think how you're going to get that growth pace is going to be interesting. I mean, it looks like on the social media side of things, you're seeing some additional share gain taking place there relative to what you're seeing on the search side of things. Although Alphabet, you know, to be fair, did not provide any type of guidance on their end, but it appears like that momentum continues to really be taking form on the social media side of things. We'll get some additional numbers next week when the Snaps and Pinterest of the world start reporting, but they're a much smaller player in this industry. But I think at the end of the day, the numbers look pretty good for us. There's probably upside to those assumptions that I provided to you because of some of that AI play and the fact that you're going to see an acceleration, you know, away from those traditional sources to more of the digital side of things.
Hey, Angelo, taking a look at just the run that we've seen with some of these guys on some of the numbers, even NVIDIA at another record high today. What stock is most over their skis right now?
Oh, that's a great question. That's a really good question. You know, as far as, you know, we're concerned, I'd say the names we like the most, the ones where we're absolute table pounders on, are Microsoft and NVIDIA. I think those names on any type of pullback, you just continue to load up and buy more of it. You have to love kind of the meta results here. But if there were a name I were to throw out there right now, it would probably be Meta. One, because of the type of move that you've seen in the stock today. I'd also say that the comps do get a little bit more difficult in the second half of this year. So there could be a scenario where as those comps get a little bit more challenging and they need to, you know, potentially, you know, spend a little bit more, that could kind of set up some potential disappointment later this year for the stock. So that's probably the name where maybe I would raise a little bit of an eyebrow among kind of the, you know, the Mag 7 names right now.
Hey, Angelo, thanks a lot. Super appreciate it. Angelo Zeno, Vice President and Senior Equity Analyst at CFRA Research. See, I told you I could find something negative or mildly negative a little bit there.
The stocks have just been running. They've been leading the market. They took their pounding back in 2022, of course. But again, it's tough to bet against these names. It really is. I hate to be a fund manager and not have my positions locked in on these names because, you know, it's going to be painful to do it now, but I would even do it now.
And it also just raises the question, oh, okay, then you get the CTAs, like you're going to have to rush in, like are we going to get even more building on the rally, et cetera, et cetera.
Yep. All right, looking at the markets here, S&P 500 up 0.7%, NASDAQ up 1.2%. So there you go. Russell off about 1% here. Yields, keep an eye on that. 2-year Treasury up 18 basis points. That gets your attention, 4.38%. The 10 years sitting at 4.04%. This is Bloomberg.
Intelligence, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Earnings from Meta and Amazon.com powering those stocks higher. And that is enough to push the S&P 500 to around a record. So if we keep at this pace, we will close at a record high for the broader index. Treasury yields leaping after that stronger than anticipated January employment data. So that strengthens the case for the Federal Reserve to defer cutting interest rates until at least the second quarter. Yet non-farm payrolls surging 353,000 last month. Basically, if you have a pulse, you can get a job, is what that says. This strong economy may continue to bode well for corporate results, may also be a factor delaying the Fed's pivot. Right now, you have the S&P 500 30 points higher. That's up 0.6%, 49.36. The Dow Jones Industrial Average 51 points lower. The Nasdaq 100 207 points higher. That is a rise of 1.2%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus with Joe Mysak.
It is Friday. That means we talk municipal bonds. Focus on Munis is brought to you by Build America Mutual. Build America Mutual insures U.S. municipal bonds that finance essential American infrastructure and provides guaranteed income to improve any portfolio. Be part of Building America. Invest in BAM insured bonds. You
Excellent.
See, we got to bring Matt Miller in just for the BAM thing.
Only he can do that.
Only he can do the BAM. All right, Joe, thanks so much for joining us here. You're here in studio like you always are. Never mail it in. Always coming in person. We appreciate that. Talk to us about, I want to just go right to the new issue market. How is it new? Have we been issuing bonds here in this first month of the year?
You know, Mr. Sweeney, this has been a very busy month, or January, I should say, was a very busy month for munis. Normally, it is a light issuance month, maybe 25 billion, a little over 20 billion, really. But this time around, we had more than $31 billion in municipal bonds sold, which is a big month in munis. You know,
why is that? Is it just because you have told us in the past, municipalities issue debt when they need it, not necessarily when the market says it's time to go.
Right. And basically what we came up with is that it was a very light December. When you have a light December, you're going to have a heavier January. You know, it frequently moves, you know, no more than that. December was like a $22 billion month, and normally Decembers are heavy as people want to get deals done by the end of the year. There was nothing pushing municipalities to sell bonds in December. So January comes along, and they really stepped up. And the amazing thing about it is that you had very, very good acceptance for all the issues. It didn't, you know.
They didn't have to do anything extra.
Supply and demand really kind of matched up, and municipalities were able to sell debt at very efficient rates.
Any stumbling blocks, like anything that stood out that didn't quite go according to plan?
No, actually, everything was priced to perfection. Believe it or not, they really. And I had a couple of people tell me, "Wow, things really occurred in January, and things just went along, and got the bonds sold. Very good month."
All right, talk to us. I'm looking at my INGO function. It gives you the Bloomberg Index browser. You click on municipal bonds. You guys, I see some green on the screen. There's some positive returns, just by a hair. I mean, we're not going to go crazy here for the month of January. How have the bonds been trading?
Well, actually, January we actually had a loss.
Oh,
but the last couple of days, because of the bank-fueled rally, which lasted, I guess, 2 days until the employment decline in yield or increase in yields. Yeah, we rallied at the end of the month, and so right now I think we're, we were down 0.51% in January, and like you say, we're in the green now because we've had 2 days of rallying.
So let me ask the silly macro question, because the amount of things I know about munis I can probably put in one hand.
You should have some in your portfolio.
Okay.
That would be my recommendation.
Tax exempt.
Okay, that is true. Yep. That I know. If the Fed doesn't cut rates in May, if they don't cut 5 or 6 times this year, how does that affect the muni market? Like if I'm an issuer and then I'm a buyer.
Well, okay, here we go. I mean,
oh boy.
You always
can of worms.
Yeah, I mean, now it's just, speculation. But Fed cuts interest rates. Yields go down on treasuries. Yields are probably going to go down on municipals. And I would say in February, we have a lot of money being returned to investors in the calls and redemptions, maturities. And that money usually seeks a home back in the municipal market. And in February, it's more than $30 billion. I think we have $34 billion coming in, which $34 billion would be a very big month. So you could see there's supply and demand there. But in March, April, May, it's there's not as many bonds maturing, not as many bonds being called. So you're going to see pressure. So that's pressure on yields to go up. So if we don't see any cuts, because I don't know, Mr. Tucker, did you really think March was a possibility? Come on.
Actually, I did.
And now we're talking about May. Like, come on, I really don't think so. But so we're going to see this kind of maybe a kind of stasis. But obviously, if the Fed starts cutting rates and all yields are lower, you're going to see yields go down across the board. Municipals always lag. So
what is the lag? Well, what's normally the lag for that?
Oh, right now, for example, the 10-year is yielding about 60% of treasuries. Should be yielding in the 80s. Oh. Okay, and you do get the ratio in the 80s when you go far out in the yield curve. So 25 to 30 years, that's where you're seeing, what you should be getting right now.
Joe, any fun issuers in the marketplace? Usually have some cool, unique type of issuers, whether it's building a football stadium or, a train to nowhere or something like that. What do you got for us?
We don't, right now, it's been a very, January was a very, I want to call it like bland month.
Okay, bridges.
So lots of issuance, but nothing sexy.
Yeah, we had the Curtis School out in Los Angeles, which was a grammar school, kind of a catering to the elite. Yeah, but
really?
Tucker's throwing up his hands. Yeah,
wait, why it's no.
Remember the broiler mortality?
But it's not
issue.
the broiler. See, yeah, it's not anything
we did this
like
years
that.
Ago.
Yeah, looking down the line here, okay, I can see things are going to be loosening up soon. So. Yeah, nothing really.
Anything on the calendar? How's the calendar look? I mean, I know Citibank pulled out of the municipal bond market. How are the rest of the underwriters doing?
This is you bring up an amazing point. The calendar is issues are coming into the market. We're seeing robust issuance. $31 billion in January, and yet. It is coming in a very slow, steady fashion. So there's nothing overwhelming the stasis right now in the market. Amazing. I looked, I think, in, our visible supply figure. What's coming over the next 30 days? And it's, between 6 and 7 billion for the last couple of days, which is a kind of light figure. And yet, when the weeks come up, you see the, issuance climb. So right now, things are copacetic.
Are they flush with cash, the municipalities?
Oh, the municipalities are still relatively flush with cash, but The investors, of course, they have the money coming back to them in the forms of maturing bonds and
called
calls.
bonds.
So they get that. And the mutual funds have actually been getting inflows over the last 3 weeks, which is, amazing in munis because we spent so much of 2022 and 2023 with outflows. So they have money. So there is a lot of demand that's setting up, which is good for issuers because that keeps yields very low for them and for you as a taxpayer.
I'm really impressed with my second Muni Friday, I think, right?
Oh, nice. Yeah,
I'm really impressed by how much enthusiasm our Muni reporters and BI intelligence guys have.
Oh, they
over
do?
Munis.
You have to.
Of course.
Joe's Mr. Municipal
It is
Bond.
infectious. I like it. I'm excited
All right,
to
let's
learn
not
more
get
about
crazy.
this.
Let's not get crazy.
I mean, on a relative basis,
On a relative
yeah, I'll
basis.
take it.
And that's how these bonds trade, on a relative basis. Hey, Joe, guess what?
No, that's it?
That's it,
No.
my friend. Thank you very much once again, Joe Mysek. He does all the municipal bond stuff for Bloomberg News, and we talk munis every Friday because it's a big part of the market. And for retail investors, it's huge. You get triple tax-free. I every time I bump into the mayor of New Jersey, which I tend to do, the circles I travel in, I just say, hey, man, I'm like the biggest creditor to the state of New Jersey. You better be nice to me. Yeah.
Oh.
I'll see him down at Charlie's every once in a while.
Mr.
Are you guys going to jump into the...
Mr. Murphy.
Yeah.
Well,
Exactly.
it's all
Jump
the
into the
Irish
ocean
people
this
hang
weekend?
out together.
Oh, is that what
That's
that
the
is?
thing.
Okay.
Exactly.
Well,
So-
what are you doing tomorrow again? You're jumping into...
The Polar Plunge,
Polar
Seagirt, New
Plunge.
Jersey. Come on down. It's for a good cause. The sun will be out. John Tucker, he's local. He could come down. No problem.
I just got out of the hospisptal with pneumonia. You
this
think I'm
is
just going to jump in the freezing
That was like
ocean?
December, man.
Yeah, I'm
I
sure
mean,
you're gonna be fine.
a
No,
little
no, no,
wetsuit there. Anyway, looking at the markets here, you're looking at two-year yield continuing to climb up by 18 basis points. Equities, though, holding on to the gains thanks to tech. Let's go over to Amy Morris with National News.
All right, thank you, Alex. The Senate gearing up to vote on a deal to secure the southern border and provide new military aid for Ukraine. Senate Majority Leader Chuck Schumer says lawmakers are close to reaching a deal, and the first vote will be no later than Wednesday.
Conversations are ongoing. Some issues still need resolution, but we are getting very close on the National Security Supplemental.
The bill will include border policy changes to stop the flow of migrants coming across the U.S.-Mexico border and funding for Ukraine, Israel, and Taiwan. The path of the deal, though, is uncertain in the House. More than 800 officials in the U.S. and Europe have signed a letter protesting policies in Israel that they say could be contributing to war crimes in Gaza. The New York Times reports the public letter of dissent is the first instance of officials in allied nations coming together to openly criticize their governments over the war. Donald Trump tells Fox Business in an interview he would not reappoint Jerome Powell as chairman of the Federal Reserve if elected president. We talked about it with Bloomberg government reporter Zach Cohen.
So this increases the amount of pressure on Powell and the rest of the Fed Board of Governors as to determine whether and how to decrease interest rates again as soon as their March meeting in an effort to try to keep the economy humming as inflation continues to cool.
Trump says he's concerned the Fed's trying to lower interest rates just in time for the election. The verdict in New York's $370 million civil fraud trial against former President Trump may not come until mid-February. The delay pushes the verdict closer to the February 24th South Carolina primary. Trump also faces a decision at any time from the Federal Appeals Court in Washington over whether he's immune from prosecution over his attempt to overturn the 2020 election. And Trump says he plans to appeal an $83.3 million jury verdict against him in a defamation suit. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Strong earnings reports helping push the S&P 500 toward a record close. Right now, the S&P 500, 43 points higher. That's up 0.9%. And the two leaders there, Meta, 20% higher. And then Amazon.com, that is up close to 8% higher. Then the data this morning, that was an eye-opener. Employers adding the most workers in a year. Wages jumped. A surprise re-acceleration in the U.S. labor market. Before that data, Morgan Stanley chief economist, U.S. economist, Ellen Zentner was telling us don't expect the first Fed rate cuts until a little later this year.
I think it can wait a little bit. So we've had a June call. We've had a June call for a while here. And look, I still think the risk is to earlier than later. Well, that's easier to say, earlier than later. But we've been pushing back pretty strongly against March.
Well, the swaps contracts tied to the Fed meeting dates further reducing the possibility of cutting rates as soon as March. Traders also trimming the total cuts they see for all of 2024. After that data, the two-year yield, that surged. Right now it's up 18 basis points, 438. Right now, the two-year. As we look at the S&P 500 again, 43 points higher. The Dow, that's turned around, now in the green, up 50 points. That's up 0.1%. The NASDAQ 100 up 253 points. That is up 1.5%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Alex and Paul.
So, do you guys like Taylor Swift? Is this a
I
thing?
admire her greatly. I don't listen to her music, no, but I really admire her and everything she's done.
I couldn't tell you one song.
My 27-year-old daughter is a big Swiftie. Went down to Philadelphia, couldn't get the tickets to the New York show, did not deter her. Went down to Philadelphia, got a hotel room, stayed over, probably had some meals out, contributed to the Philadelphia economy, and saw her down there.
So how much do you think, like, ballpark that she spent on all that?
$300.
And that's just one, and that's just one ticket.
Yeah.
So my daughter's 9, and she just turned into a Swiftie. We don't know how that happened. We don't know how she found her songs, knew her songs, learned her songs, but now it's like Swift all the way.
Nice.
We're waiting for her to be like, can I go to a concert so we can spend $1 million? But it turns out, not only Taylor Swift is positive for GDP, but also potentially positive for gambling. So to get that, you sigh.
Yeah, I know,
you
I get
sigh.
it. It makes sense, but...
So she'll be at the Super Bowl, right? Because she's dating someone from...
Travis Kelce.
Wait, I thought she had a concert like in Europe.
No, we've worked
Apparently
all this out.
we
We've
worked
worked
all
all
this
this
out.
out. She's with the jet travel, amazing things can be done.
Yeah, so she's like jumping off the stage and like running onto a plane and then and going over.
Travis Kelce.
Tight end for the
49ers?
Do you think
Kansas City
that's
Chiefs.
really a
Chiefs.
romantic relationship?
I do.
that's
I
like
think it's
really-
real. I think it's
for real?
absolutely real. I'm down
Also,
with that.
like, who cares?
Yeah,
I'm all in.
He's all in. I bring this up because if she is the most recognizable face in the world, does that actually mean more people watch the Super Bowl and more people do things like bet on the Super Bowl, which helps things like FanDuel and DraftKings? Am I making too much of this, or could this really be a thing? Brian Egger joins us, Bloomberg Intelligence, a senior gaming and lodging analyst. Brian, am I just overstating her influence here on the gaming world?
I don't think you want to understate it. I mean, the broad correlation we see is that viewership of sports drives sports wagering. And what drives viewership? I mean, many factors, but certainly among those, appearance by Taylor Swift would be a major factor. There are others, but the anticipation, the possibility of whether or not she'll attend, I don't think we know if she will. It certainly adds to the excitement, which is already there in the first place because the event is in Las Vegas for the first time, right? So.
Well, I mean, there's prop bets on whether she's going to attend and when she'll get
stop.
there. Everything.
Seriously?
There's a prop bet on everything. I mean, so Vegas is my town, Brian. Let's be honest. We all know that. How big? Like, what are the companies saying about the impact having the Super Bowl and all the crazy people from all over the world that are going to come to participate in it? What's the impact on the Vegas and the gaming companies, the casinos, all that stuff?
Yes, I mean, historically, sports betting has only been about 3% of total gaming revenue in Las Vegas, but it's a hugely important traffic driver. So we retain the premise that the availability of people, the crowds, the attendance, the excitement will drive hotel room rates higher. We already have some data in our report that shows that they are higher even than they were for the Formula One Grand Prix in November. And they will also drive table game wagering and things of that nature. So certainly it's going to bring a lot of people to Vegas in close proximity to the major resorts. And, it should be very strong for the top line. We'll see about the margins and other related cost considerations, but definitely a huge traffic driver.
Who wins? Yeah, go ahead.
And I just heard I just heard of a group of people going to Vegas, but they're not going to the hotels. Hotels are too expensive. They're getting an Airbnb. So even that part of them, which I never thought of. I just thought you go to Vegas, you go right to the strip hotels.
Can I ask a dumb question, though? Like, if I'm going to Vegas to bet on the Super Bowl, why can't I just watch it from home and then bet online?
You can, but it's all about being in Vegas. That's fun.
That's fun. Okay.
That's fun.
So, Brian, who wins? Airbnb?
We've heard about both. We had a report last week showing how Vegas should benefit in terms of room rates and hotel and table game wagering. And we have a report out this morning actually talking about how online wagering for apps like FanDuel and DraftKings should bet from the Super Bowl, certainly from the fact that there are at least 4 more betting states in operation this year than there were a year ago. So, I mean, all these things contribute to a potentially very favorable environment for sports wagering online, which, of course, is Paul's kind of suggesting outside Nevada, online is the preponderance of sports betting.
And where are we, Brian, with the number of states that have legalized online gambling? It's not nationwide, is it?
Not nationwide, but we're certainly well into the mid-30s for states that have some form of sports betting. In terms of mobile sports betting, we're somewhere in the high 20s. Since last Super Bowl, new to the sports betting fray are Massachusetts, Puerto Rico, Kentucky, and Vermont. Those are all markets that have started online wagering, reaching about 5% more of the population than a year ago. So, about half the population, roughly, in the U.S. has access to some form of mobile sports betting.
That is amazing. Talk to me about margins for a second. How do margins in sport betting work?
So, the source of the company, the sports books themselves get a bigger commission, which is why, when you bet $100, $110 to win 100, for example, in some cases. So that's kind of the source of the revenue. The margins, it's a bit more complicated because the margins can be affected by things like promotional spending, customer acquisition spending. So, these sports books now, we talked about it last week on the air, DraftKings just reaching EBITDA profitability this year going to next year. Not because there's plenty of wagering going on, but it takes a few years for these states to mature, for the customer acquisition cost to come down. So a lot of those marketing considerations go into what affects margins.
Hey, Brian, stepping away from the Super Bowl, how is Vegas doing in general now in terms of business level activity vis-a-vis pre-pandemic?
Yeah, I mean, Vegas is doing very well, up certainly compared to last year and up well over 2019. At some point, I think the comps get tougher, but certainly we're well beyond pre-pandemic measures of gaming activity and room rates. So Vegas is doing well, with all the obvious caveats about the economy.
Do we have a favorite game in Vegas? I'm
Craps at the Bellagio.
Really?
Yeah.
I'm a Texas Hold'em girl.
Really?
Yeah. Love it.
That's interesting.
John Tucker made a face, but it's true.
No, I was like, I'm just stunned. I'm like, who knew?
Yeah, I used to play tournaments when I was in my 20s.
You used to play tournaments?
Okay.
Oh, my God.
Let me clarify that. Not at casinos, but now I go to casinos, and I don't play tournaments, but I do like the table.
No kidding.
Mm-hmm.
I would pay to watch that.
We're going. Road trip.
Hey, Brian, talk to us about the regional casino business. Outside of Vegas. How's that doing in this country?
Regional casinos are doing well, and I think particularly for both regional casinos in Vegas, December seemed to be quite strong based on the numbers we've seen. The comps get tougher because beginning in I guess like the summer of 23, the business was quite strong, and so 22 I should say quite strong. Comps get tougher, but the regional casinos are doing well, and the sort of collateral effect of the pandemic was that companies dramatically reduced operating costs. And so the margins are really much higher than they were before the pandemic.
Housekeeping.
They are leveling off and starting to come down with more labor, but that's it's certainly been quite strong.
All right, Brian, thanks a lot. Super appreciate it. Great stuff. I also like AC. I know, I'm very strange. Brian Edgar, Bloomberg Intelligence Senior Gaming and Lodging Analyst. Weird, right?
Shocked.
Did not see that.
I don't know what to say.
I know. Like, what does it say about me?
So
I'm not really sure.
All right. Well, that's good to know.
I mean, I guess.
All right. Very good. S&P 500. It's up about 1%. We're having a little bit of strength here in this market. We'll have more coming up. This is Bloomberg.